Good afternoon. Let us start the Western India Accounting Conference with ICAI motto. Good afternoon.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैत 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 एतद्द्वैत.
Past President of ICAI, say Manoj bhai Fadnis ji. Chairman of WRC, say Manish bhai Gadia ji.
2 minutes.
Chairman of the branch of WRC ICAI, say Harit Dhariwal. Vice Chairperson of WRC, say Dashri Desai. My council colleague, say Vishal bhai Doshi. And all the participants, welcome all of you to the first day of the Western India Regional Accounting Conference. We all are passing through the very rough phase. As we are discussing before this previous session, that everyone, whether it's Maharashtra, Gujarat, MP, Delhi, everyone is facing a tremendous challenge. Where the COVID has been one of the most biggest issue which we are all facing. But there's no need to worry about that. What is most important that we all should come together. We should all support, and this time is going to go end. One very important liner: कभी सुख, कभी दुख, यही जिंदगी है. ये पतझड़ का मौसम घड़ी है. नए फूल कल फिर डगर में खिलेंगे. नए फूल कल फिर डगर में खिलेंगे. उदासी भरे दिल कभी तो उठेंगे. So with this great hope, what we need to all ensure that these are the small moment which is going to go away very soon, and we all must come together. We all must be united to see that. Let us help our profession. Let us help all our fraternity to ensure that we can stay together and do growth. As I talk about this accounting conference, I think we have seen a lot of changes in accounting conference, where from traditional bookkeeping to computer-based accounting, from computer-based accounting to the IFRS, and then digital accounting. So a lot of things have been changed here. And during this particular conference, our aim is to cover first on the global challenges due to IFRS, global challenges with respect to particularly COVID. As there was a discussion going on with Manoj Fadnis sir, we are focusing on post-pandemic, but however, right now the topic is during pandemic. So the challenges during pandemic that we need to address during this session. Additionally, we have also covered on Schedule 3 amendments, and one of the most important change, if I focus since Company Act 2013 on financial statements, is the Schedule 3 amendments. And just to highlight and learn from our mistakes, we also covered common errors observed in accounting standards, followed by the panel discussions from the CFOs of industries that will really give a lot of practical issues and opinions behind that. So I'm thankful to the chairman of WRC, Manish bhai, for always being there to support him in this particular session, and also the chairman of the branch, Harit Dhariwal, to see that this particular conference can be arranged and organized smoothly and effectively. So with this brief word, now I request CA Harit Dhariwal, the chairman of the branch, to address the gathering.
Thank you, Chintan bhai. Respected past president of ICAI, CA Manoj Fadnis sir, chairman of WRC, CA Manish Gadia ji, vice chairperson, CA Dashri Desai ma'am, Regional Council member and Chairman of the India's Committee of WIRC, CA Chintan Patel, Secretary of WIRC, CA RPG Kabra, RCM, CA Vishal Joshi ji, and all other dignitaries who have joined this virtual conference, and all the participants who have logged on virtually. A very warm afternoon to all of you. I hope you all are keeping safe and keeping well and safe. On behalf of Ahmedabad branch, I welcome you all to the Western India Accounting Conference organized by WIRC and hosted by Ahmedabad branch. At the outset, let me thank WIRC Chairman CA Manish Gadia ji and his entire team for giving us this opportunity to Ahmedabad to host a virtual regional accounting conference, and CA Chintan Patel, our RCM and Chairman of India's Accounting Standards Committee of WIRC, for designing such a wonderful two-day conference. The measure of intelligence is the ability to change. That is what Albert Einstein had said. And as a chartered accountant, we have to constantly evolve and update ourselves to meet the expectations of the stakeholders. The topics of this conference, as Chintan Bhai just said, are so apt and relevant in these times. I would like to thank all the learned speakers for accepting our invitation and sparing their valuable time. It's been 2 months that I've assumed the charge as chairman of Ahmedabad branch. The theme that we have chosen for this year revolves around the 4 letters that we are so proud of, and that is ICAI. I stands for ideation, C stands for collaboration, A stands for adaptability, and I stands for innovation. And that will be at the center of all the events that we are planning. Very happy to share that in the last 1.5 months, we have conducted 8 vaccination drives with more than 1750 members being vaccinated. Food Kit at Your Doorstep is an initiative of Ahmedabad branch, especially for chartered accountants, members, students, and even non-members who are quarantined because of COVID. And ever since we started this from April 12th, we have had more than 3,000 food kits delivered across the city of Ahmedabad. We have also started an initiative, We Care, where the members of our managing committee meet the senior members at their office to take suggestions, guidance, and blessings, and also to take feedback as to how the branch can help them. Ahmedabad branch has also undertaken a mega health and fitness initiative called Movement 73, a virtually organized fitness event with 40 other branches of ICAI. And this 73-day long event is not only helping members toward their goal of being healthy and fit, but also acting as a common connect to all the members to share their ideas and thoughts in these difficult times. Pleased to share with you that as I speak, we have more than 2,100 participants across the nation and even few from overseas. We have recently also launched blood donation and plasma donation drive at Ahmedabad. Today, we are also very happy to share that we are launching a car facility on call for all the COVID patients to help them commute to and fro from the healthcare facilities. I would once again thank Manish ji for his guidance, and sir, we at Ahmedabad branch assure you that we'll always be there to support you wherever you require us. I wish all the participants of this conference a very, very happy learning. Thank you so much.
Compliments to Harit, the fabulous effort which is taken by Ahmedabad branch. I think at the core of everything is to ensure that we want to take care of our members in these difficult times. So fantastic efforts, and we wish that it should continue. I request the Vice Chairperson of WRC, C. Darshi Desai, to address the participants.
Thank you, Chintan Bhai. First of all, I would say that I'm quite privileged to be on the dais where our past president, Sir Fadnis, sir, is also there with us to guide us. So thank you, sir, for giving us this opportunity to be here on the same dais. I would congratulate Chintan Bhai for this wonderful program that you have put up. Congratulations, Ahmedabad branch, for this fantastic support that you have provided and the program that has been put up, and Manish Bhai and all the office bearers of WRC and my regional council colleague Vishal Bhai for wonderful teamwork. Now, at this platform, I would like to talk about 2 things. One is that at WRC we have, at least what I would say is that focus on we will run. Is that coming from my side?
Harit, I think there's some static. If you can just mute.
So there are clinics or help desks that we will run, and we are shortly going to roll out a clinic for charitable organization re-registration, where there is a panel of experts who would answer the questions that members would have. And this will be, we'll have roster for each week, and there'll be 4 people on for each week to answer the questions, and we'll have a quick rollout, quick turnaround time for all the questions. This will really help members in solving certain ambiguities which are there in the form. We'll continue to roll out these types of help desk for various other things which will keep coming up, and members will have will need some support. So that is what we would like to do at WRC. The other thing is we are going to run, and we have run already, a specialized focus series like what currently you are attending, which is completely focused on accounting standards and the issues. So it's a wonderful program. So some things like that will keep on running in the coming month. Also, we have several such specific focus series. And the R, by R we mean we'll do a reach out through the clinics and the issues that we get from the members. We can then do our representation work to the right forum. So this is what we want to do this year at WRC. Other thing that I would like to inform or update all the members about is that we have rolled out something called Khoj. It is a portal for women members who want to get employment after probably a break or even otherwise. It's open to all women members, whether you want part-time, you want full-time, you can do your selection, and you can get your employment using this portal of Khoj, which is on WRC website. You can go there, register yourself there, and then it'll be a wonderful bridge between prospective employers and the job seekers. So these are the two things that I thought I would highlight at this forum. And that's it. And I would wish everyone very, very happy learning for this wonderful program that you have today. Thank you. Over to you, Chintan bhai.
Superb initiatives shared by Darshiban. I think it's really heartening to always see that the initiatives taken by WRC. I request the chairman of WRC, CA Manish B. Gadia ji, to address the participants.
Thank you, Chintan bhai. It's really a great privilege for me also to share dais with none other than our past president and guiding force, CA Manoj Fadnis sir. So really, you give lot of encouragement to us, especially in the program of accounting and auditing. So there will not be any other keynote speaker as you are, sir. So really thank for accepting our invitation. I thank Ahmedabad branch also for joining hand together to have this wonderful program. And of course, Chintan bhai, you are working since last 1.5 months for structuring, designing this program. Really great, Chintan bhai. So dignitaries on the dais, first of all, I will request all the members to take care of yourself, your family, stay at home. Do not move out of your home unless it is very much necessary. So that should be the first priority. And once you are at home, so at WIRC, at institute, at various branches, we are having various kind of learning series. You can take the benefit of the same. Ahmedabad branch, as Harit has said, that they are running a Fit 73. So while at home also, you can remain fit. So take that benefit also. So WIRC this year working on a theme called Breath the Change. So that is what we want. We need to change according to time. The last year in this time, maybe 11, 13 months earlier, if you would have thought of having any virtual webinar, so you all of must have asked, laughed on us. But now it is the reality. So we have to change according to time. Otherwise, difficult time will be there. So this is what the breath that change. After that, you have to organize yourself, your office, your infrastructure, your skill set, everything. Learning is of course very important. L means learn, and then the best deliverable service you have to give to the society. On this entire theme, we are working, and we are having various focus series. As Drusti madam has said, we are also going to start learning from legend series, where you will get a life experience of a legend of the profession. Apart from that, we are also going to start a CEO speaks. Journey from CA to CEO. Again, a chat show, a learning from, you can say, CEO. So these are some of the initiative. Apart from that, Women Wow series, all that we have already discussed. Then in WIRC newsletter, you must have seen that we have started 3 new columns, 3 new updates, that is SEBI, RBI, as well as merger and acquisition and valuation. We have requested to, we have emailed to all the CA members who are women CA members who want to be a faculty at WIRC, at branches, at various study circles. So mail has been sent. If you are really interested, you can fill up the form. So then definitely we will try to give the opportunity to all of you. On 14th May, that is on Akshaya Tritiya, we are again going to start a new series, that is TEL. What is TEL means? Train, earn, learn. Where we are going to give 36 hours of training to a BCom student. What should be the office etiquette? How email should be drafted? What should be the communication? How to file GST return? How to file income tax return? How to do audit? How the accounting to be done in all these 36 hours. After that, you will place that BCom student at CA office to get training of at least 1 year. While that, he will also get some kind of stipend and he will learn and earn. This is what we call train, earn and learn. This is what we are going to launch on 14th May, that is on Akshaya Tritiya. Apart from that, we are also going to start CFO Forum, mentorship program. Again, you can visit WIRC website for the mentorship program. We have started a new initiative, that is short videos of updates. So anything new comes, you will get a video within 1 or 2 days, a short video maybe of 1 minute to 3 minutes. You will get a capsule, so you can watch that video and the implication you will understand in very simple language. WIRC this year has published 1 book till now, but in couple of months we are going to publish 11 new publications for your benefit. So thank you very much. I am not going to speak on a topic because Chintan Bhai has already covered, and we have with us none other than Manoj Fadnis sir. So it is his. We want to listen on the topic from him only as a keynote speaker. So thank you very much. Over to you, Chintan Bhai.
Thank you so much, Manoj bhai. I think you have shared a very important initiatives, and one of the very important touching for everyone is about TEL. I think that's a game changer. The way the articles are not available, and this is going to really be very useful, immensely useful to many practicing CAs, where instead of articles they can get trained BComs. So fantastic efforts, Manish bhai. And as everybody said, we have today with us the keynote speaker Manoj Fadnis ji. I think he need not require an introduction. The person with whom we all are there, the fortunate to have to share that with him. But still, I request as a part of our official and request Vishal Doshi, the RCM, to introduce briefly our keynote speaker Manoj Fadnis ji.
Good afternoon, everybody, and thank you for Chintan. At the outset, compliments for organizing this wonderful Western India Accounting Conference. It is indeed a privilege for me to introduce CA Manoj Fadnis ji, who was the president of our institute for the year 2015-16. Sir was the president of CAPA, which is a regional international organization of 32 professional institutes from 23 countries of Asia and the Pacific region, for a term of 2 years from 2017 to 2019. He was also the non-executive director of the IRDA and also member of the National Direct Taxes Advisory Committee of the Central Board of Advisory Committee. Sir was nominated as a member of the Small and Medium Practitioners Committee, the SMPC, of the International Federation of Accountants, the IFAC, and has also been nominated on B20, which is a business group formed by the G20. Presently, Sir is independent director on the board of Federal Bank and he serves as the chairman of the audit committee. He is also on the board of other listed and non-listed companies. He is nominated as a member of the Standing Committee on Accounting Issues constituted by the IRDA. Sir was also member of the Company Law Committee set up by Ministry of Corporate Affairs in 2015 for the amendments required to the Companies Act 2013. He was nominated by SBI as a director on the board of the State Bank of Indore from 2002 to 2005 and was the non-executive chairman of the MP Stock Exchange Limited from 2012 to 14. Sir has specialized in corporate accounting and reporting standards and direct taxes, corporate laws, and FEMA. He has presented more than 1,000 technical papers in seminars and conferences within India and internationally. Friends, please put your hands together in welcoming CA Manoj Fadnis ji. I would now request Sir to kindly deliver his keynote address.
Thank you very much, CA Vishal Bhai. Honorable Chairman of Western India Regional Council, CA Manish Gadia ji, the Vice Chairperson, CA Drishti Desai, the distinguished Regional Council members, Chintan Bhai and Vishal Bhai, CA Arpit Kabra ji, Chairman of the branch, CA Harshit Dhariwal ji, and all the members of the Managing Committee of Ahmedabad branch. Our very distinguished speaker, Ms. Silvia Mahutova. Welcome to this webinar. Good to have you amongst us. And as Ms. Silvia is going to speak upon what is the global challenges in accounting post-COVID, I thought I'll take up the challenges during the COVID. In fact, we thought we would now be entering into a post-COVID era, but as all of us are aware, in India, we still have COVID going on and maybe a little more ferociously now as compared to what it was last year. So be that as may, we are used to such challenges and I'm sure collectively all of us will rise to this occasion, help our brethren who are fighting this COVID at different places. And my compliments to Ahmedabad branch and also to the Western India Regional Council for taking up so many initiatives to not only help our members, help the society at large, and also the various initiatives taken on the professional fronts so as to have better deliverable services from chartered accountants to the society. My compliments particularly to the chairman of the Western India Regional Council. Some of the initiatives which you mentioned, which you are starting on the holy occasion of Akshaya Tritiya on 14th of May, are extremely commendable, which will help people from various strata of our society and will empower them to come forward and educate themselves, learn, and at the same time earn, which you said, and I'm really pleased with this particular initiative of you. Friends, I compliment Ahmedabad branch of Western India Regional Council for organizing this accounting conference when we are talking about accounting. And we have a very distinguished international speaker who is going to tell us about the global positions in accounting post-COVID era. And I'm sure there will be a lot of challenges and a lot of interesting things to hear and learn about what is happening globally with respect to these challenges. During the COVID period, as we are right now, within the while most of us would be finalizing the financial statements for the year which has just ended on 31st of March 2021, some of the listed companies have already come out with their financial results, and many would be in the process of coming out with these financial results in the next couple of weeks. Now, this is what is one of the biggest challenge for us as auditors when we are still required to apply our full professional judgment, professional skepticism, as we say, and still look at very soft accounting issues and audit those accounting issues. So in a COVID period, as we are now, the pandemic started a year back, and we thought it would end and March 21 would be a better balance sheet where we would have a clear visibility of the future. But today we find things are still hazy. And in such a hazy environment, matters like provisioning for expected credit loss, testing the impairments, and particularly testing impairments of intangibles and testing impairments of goodwill and goodwill on consolidations, and at the same time still maintaining adequate audit evidence for the work which we have done in this remote audit situation is really going to be challenging. And I'm sure greater the challenges, more, as we say, necessity is the mother of invention. So a year back, we never imagined we would be so well connected through technology. And the last 1 year, the kind of progress which we have made on technology is maybe 10 times of what we would have done in a normal situation. So technology has to be used to the hilt, and we need to look at these soft accounting issues, be it with respect to COVID provisions, impairment provisions, goodwill testing, and other things which will come up. We need to look at them very, very carefully. Friends, what we have also seen in the financial statements for March 2020, that is for the previous financial year, the COVID losses have been quantified by many companies as exceptional items in their financial statements, and very rightly so, because suddenly the things in the last year up to mid of March were going so well, and in the last 2 weeks, and particularly in the last 6 to 7 days, starting from more particularly 25th of March 2020, the companies started incurring huge losses. So in that kind of a situation as we were, many companies have quantified those COVID losses and has shown them as part of exceptional items. Now, these are matters where the companies have to take a judgment, and we as accountants and auditors need to see that proper judgment is applied in these areas. If the COVID loss in March 2020 was an exceptional item, whether it can still qualify as an exceptional item in 2021 is something which is a matter of judgment. I don't intend to say that it is not an exceptional item. It could still be an exceptional item, but these are the areas where we'll have to apply our mind and look at the situations in a more careful manner. Friends, we have enormous strength as a country. And when we look at the financial statements of our companies, they come up with a lot of challenges. I mean, we can see the challenges coming out of these financial statements. We can also see how the accounting issues are being addressed. And there is a great learning which we have in even in reading these financial statements. I've been particularly watching how the key audit matters have been given by the auditors in the financial statements as we adopted. Now, this is going to be the third year when as auditors will be reporting on the key audit matters. So if you look at the key audit matters from the published financial statements of 2019 and how they have matured more into 2020, it makes a very interesting reading. And 2021, again, when we look at how the leases have been looked at, how the Ind AS 115 revenue with contracts with customers are looked at. So these are areas where we are going to have new issues coming up and new challenges coming up. And I'm sure conferences like this will enable us to meet these challenges and prepare ourselves well in advance to meet these challenges. I'm very happy that we have a very eminent chartered accountant, chairman of our Accounting Standards Board, MP Vijay Kumar, who is going to be the second speaker today and is going to talk about the changes which have come in this schedule 3 with respect to the current financial year 21-22. So we find that now the ratios will have to be given, and ratios will have to be disclosed in the financial statements. Variations in those ratios will also have to be disclosed. Now, there are occasions that many of these companies, many of the good listed companies, even in the past, were disclosing ratios and explaining the variations, but that used to come in the management discussion and analysis. Now, that will come in the financial statements. And when it comes in the financial statements, it becomes a subject matter of audit. And if you look at the new IAS 1, which is where we had an exposure draft recently, where now this concept of totals and subtotals and properly capturing the earnings before interest, taxes and depreciations are going to come in the form of IAS 1 and subsequently in our Indian Accounting Standard 1. So that would enable us to really be uniform in terms of computation of these ratios. So these are the emerging issues which are coming up. I'm thankful to the Western India Regional Council and Ahmedabad branch for giving this opportunity to me. Thank you so much and wish you all the very best. Stay safe, stay healthy. Jai Hind, Jai ICI. Thank you.
Thank you so much. I think, sir, listening to you is always a very, very inspiring and knowledge enriching. It's a really great pleasure for all of us to have you here as a keynote speaker. I request Secretary of WSICI, Arpit Kabra, to formally give out of thanks.
Chintan bhai, thank you. Am I audible?
Yes.
It's absolutely a privilege. Whenever Manoj sir comes and speaks, I think we all wait to hear him. In fact, for me as a youngster, I started my career. The first stint at public speaking was at Indore under his chairmanship at CIRC, and since then, his words of wisdom has always been helping me. So, sir, it's really a privilege for me again to share this platform with you. And believe me, friends, as he mentioned, audit evidence. I think that is the buzzword, that's the keyword. Despite all the odds, despite everything, the expectation of the society, the expectation of the stakeholders from chartered accountants would always be for the evidence that you have basis of your opinion. I think, sir, you have absolutely highlighted that in a very, very apt manner. And, I think this has to be the focus word for all of us, whether it is post-COVID, pre-COVID, or during COVID. And being these training sessions that we run all throughout, I think we all should really gear up to figure out how we can really work on having these audit evidences and therefore do all the rest of the work in an effective manner. So Manoj sir, it's always a pleasure and thank you for creating this beautiful platform for this conference today, and thank you for your words of wisdom. I really, on behalf of WIRC, on behalf of the Ahmedabad branch and all the participants, I extend a hearty vote of thanks and request everyone to please join hands and thanks, sir, for his comments today and for his observations today.
Thank you very much. Thank you.
Over to you.
Thank you so much, sir. It's really a pleasure to start the session with your address. Now let us come back and look at the first technical sessions of this conference. We are fortunate enough to have Silvia Mahutova. She is from Europe, and she has been a regular speaker and writing various articles on IFRS. And when we talk about the global accounting, I think International Financial Reporting Standards IFRS convergence was started in 2017. So from 2017 onwards, there's a vast change has happened in accounting standards. So AS has been modified to Indian Accounting Standards Ind AS. And right now, the Ind AS, and there is also non-corporate entities AS. So there are three things are there which we need to study: AS, Indian Accounting Standards Ind AS, and non-corporate entities AS. So I think this is what is the most critical thing. As an accountant, one of the most important things for us is to be accurate and be clear about the accounting standards. And right now, accounting standards in India are driven by the global accounting standards. So first change happens in IFRS. Was the IFRS being changed? Subsequently, there is a change in India, and then there is an impact on the accounting standards. So now we are having with us the faculty who is close to IFRS. She has been studying on IFRS way back. The IFRS are implemented. So now I request Arpit Kabra, Secretary of WSC, to introduce the faculty of the session, Silvia.
Thank you, Chintan bhai. Thank you for giving me this opportunity. Before I could go and with the Silvia, I think I'll be failing in my duties if I don't recognize the absolute fantastic work being done by the Ahmedabad branch, Harit, Anjali madam, Bhishan bhai, and I think they have been inspirational. And every branch, every place has been getting inspired by the work that they've done, be it the meals, be it the donation camps, be it everything. I think great work by this branch, and believe me, it's absolutely privilege and honor that we all are sharing the same space and the commitment towards the fraternity. Of course, under the leadership of Manish Bhai, Vishal Bhai, and Drishti Madam, we are trying to do as much as we can. But I think these are the real, pieces of work that as a chartered accountant, as an empowered social individual, we could do the best for the society. So thank you once again, all of you who are working at the ground on behalf of every one of us over here. And now I move on to introduce Silvia, Miss Silvia Mahutova, FCCA, an IFRS consultant and founder of www.cpdbox.com. She runs the website cpdbox.com, dedicated to the help for people to understand and learn IFRS in an easy way. After university studies, she started her career in auditing and consulting companies. She became an ACCA member in 2004. In 2009, she set up the website ifrsbox.com with articles and videos about IFRS and gives lots of advices to her visitors, which include auditors, students, CFOs, accountants, and anyone else interested in IFRS. She also offers her IFRS and other courses to a wide audience, and her videos are very popular on YouTube with more than 80,000 subscribers on her channel. I think that's a huge, huge achievement. In 2020, the website was rebranded to cpdbox.com, and currently it has thousands of visitors from more than 130 countries in the world. I think fantastic personality that we have amongst us. Let's join hands and welcome Silvia in this conference. Thank you, Chintan.
Yeah, thank you so much, Arpit, for introducing the faculty. And my special thanks to Silvia for accepting my invitations, because I was first thinking that shall I invite Silvia or not, whether she'll be comfortable to speak or not. But she was kind enough to say yes on the first moment itself. So thank you so much, Silvia, for readily accepting my invitation and addressing the audience. Now over to you, sir.
Thank you so much for having me on this conference. I'm really, really honored to be here with you virtually. I must say that I love India very much. I was in conference in India before, so I really loved it there. I love the people, I love the country, and I know, guys, that what you're up to right now in these very, very difficult times. And as your past president said, it's not really a speech about post-COVID time because everything is interrelated. So before I actually start speaking about the challenges, I have thousands of subscribers on my website, thousands of readers, and I have hundreds of emails every single day coming to my inbox. And these people, I see these people are struggling and asking many questions. So what I'm going to speak about today, it's going to be some sort of summary of various kinds of issues heard from all around the world, from India as well, in relation to today's situation with COVID. And as it was already pointed out, yes, a lot of it relates to ECL and impairment of non-financial assets, but it's not only that. So now, guys, I need to interrupt for a few seconds because I need to switch to another device to show you my screen. I'm sorry, but it doesn't work on my computer very well. So I'm just going to try to, to transfer, right? So I'm switching off the audio now.
Yeah, please go on. She'll just start the sharing the screen in the moment. Yeah.
Can you all hear me, please?
Yes, we can hear you. We can see the screen also.
Because there is echo. I'm sorry. I'm going to shut it down. All right. Is it all good?
Yes, all good. Please go ahead.
Okay. Now, is everything fine? Everybody can hear me?
Yes, we can hear you.
All right. Good job. So I would say that, all right, as I have already mentioned, I'm going to speak about accounting challenges in a post-pandemic world, but they are closely related to what all of us are facing right now. So I would say that I split them into two groups. I'm sorry, what is that? Oh, sorry for that. So the first one is deal with the crisis. And I will be speaking about three main topics, which is, of course, no going concern, expected credit loss, and impairment of assets, right? And the second topic that I'm going to speak about, or two more topics, is something called safe haven investments. And I will explain that, what I mean by that. I'm going basically to speak about accounting for gold and other precious metals and accounting for cryptocurrencies. Because I would say that these COVID times, they don't bring only health challenges to us. They all bring challenges, number one, to stay in business and to deal with crisis and to deal with all difficulties businesses are facing because of the spread of the virus, because of the government measures, because of closures and increased cost of productions, and because of everything like that. But there is a second challenge. No one knows what is coming, but I've heard many experts and economic people who are experts in making prognosis say that the economic crisis is yet to come. And that the things that we are facing now are not what it's coming, that the main effects of the crisis are just in front of us. Although, as you might see at the markets currently, the stock prices are very high. But the countries like US, also European Union, and I'm pretty sure about every other single countries are printing their money as a way out to help businesses and as a way out to battle the economic crisis. But as a result of printing money, there are big fears of inflation and who knows what's going to happen. I'm not an investment advisor, but I'm starting to see the trend that many people and many organizations like pension funds in the US, in the Europe, and I've heard that in India as well, are turning to safer investments, to so-called safe haven investments, like precious metals, cryptocurrencies, and all other kind of hard assets to store their wealth instead of government bonds and shares. And these are, in my opinion, issues that are not covered by the accounting standards very well, or the guidance is not so precise as the guidance for accounting for other financial instruments like shares. So this is what I would like to touch and outline what to do in this situation, right? So let me speak firstly about going concern does not apply, right? So as a result of pandemics, we all know that many businesses are going to their end, or at least they are facing the crisis, right? So what is going concern? We all know that IAS 1 says that each financial statement shall be prepared under the premise of going concern, which means that the company will be able to operate in business in a foreseeable future. That is about 12 months within the end of the reporting date. But is it true? I mean, you have said it already, that, I mean, a lot of businesses face troubles, face problems, and they are even reporting it as exceptional items, right? Which is not, by the way, what IAS 1 permits, because there are no exceptional items under IFRS. Unfortunately, it's that. So what to do if a going concern does not apply? What to do if the company has suffered such severe losses that it will not be able to continue in a foreseeable future, right? Unfortunately, there is no guidance in IFRS for that. So what we have to do is just apply IFRS to the best of our knowledge, to the best that we can. So let's say, for example, you can apply so-called breakup basis of accounting. And this is not something defined in IFRS, but many countries have it in their own legislation, something like liquidation basis. And you may look at your assets and liabilities to see if the assets of a company are sufficient to cover the liabilities and if there is something left as a surplus to shareholders, right? But if you use this basis or not, you still need to present the statement of financial position, profit or loss, other comprehensive income, and other statements as you would normally present, because there is, I mean, this is not the term defined in IFRS. So anyway, every time you are going to prepare the financial statements under no going concern basis and audit them as an auditor, you have to make sure that IFRS is applied in all respects. So not being going concern does not give an excuse for departing from IFRS. That's what I have to mention here. So the management cannot just say, okay, we are not going concern, we are going to cease, liquidate anyway, so we just don't care about going concern, about IFRS. I mean, sorry. Then I would like to draw your attention about current versus non-current distinction, because many people believe that if you're going to cease the business, then non-current assets become automatically current assets. I would like to mention that's not true. Your non-current assets stay as a non-current asset, although there are debates going around on this, if you should automatically reclassify non-current assets as current because you're going to liquidate. Well, currently IFRS just say that non-current assets become current only if they meet criteria of IFRS 5, which are non-current assets held for sale and discontinued operations. So yeah, if you actively offer some of your assets like machines, plants, or whatever on the market, and plus other criteria are met, then yes, you will reclassify your assets under IFRS 5 as current. Otherwise, you need to keep them within property, plant, and equipment. Another important consideration, as it was already mentioned, is impairment, right? If you liquidate the business or seize the trade of a production, that's a huge indicator for impairment, and then it means that you have to test your assets for impairment. But I will speak about impairment in more details a little bit later, especially what you should be aware of in the case of COVID, right? Then another consideration, valuation of your inventories. As we all know, inventory shall be carried at lower of cost and net realizable value. And if the business is going to liquidate, right, or is not able to continue, then net realizable value might go significantly down, because the businesses will maybe need to sell off, right, and offer the inventories at greater discounts. And this is also a big hint for auditors. You should really be looking at the valuation of inventories, especially in connection with closed businesses and, you know, all that things. Another huge topic when no going concern applies is onerous contracts, right? And yeah, as some contracts may become onerous after decision to close, because there might be some penalties if you know that you're not going to fulfill the contract, right? So for example, leases, let's say that you have a lease for 5 years and you cannot afford to pay the lease payments anymore, and you need to terminate the lease contract prematurely, and you might be forced to pay some penalty to the lessor. What in this case? Well, you should really revise the contract that you have and make a provision. And the IS 37 requires to make a provision in the amount lower of unavoidable cost of fulfilling the contract and penalties from that contract. So this is another important consideration. Then government grants. Yeah, many companies receive government grants, and if they are forced to liquidate, they might be required to return the grants back to the government if they're not, if they're not going to meet the objective of that grant in the first instance. So this is the outline of just a few things that you have to bear in mind. So first step would be to assess, is the business going to survive these difficult times? Are they going to receive some government support? Are they going to, stand up and go on? And if not, then you have all sorts of things to go through your balance sheet, assets, liabilities, contracts, various other things, and to see if the business is going concern or not, and make all these provisions and accounting, considerations. Anyway, I have to state it very clearly that absolutely businesses that are not going concern must make disclosures in the notes to the financial statements that the financial statements were not prepared under going concern basis. What about, all right, let's go to the next consideration. I would like to touch expected credit loss, as it was already mentioned, right? So this is the huge topic, and I'd like to mention that, again, the same screen as the pandemics, economies closed, businesses are not able to, to collect their receivables, their debts. Many people are failing, many people are laid off, many people are not able to repay their mortgages, their loans. I don't have to even speak about that, right? And what to do? So it really depends on the type of financial assets you have in your financial statements, or for that matter, if you're auditor that you're auditing. So when we have trade receivables and other financial assets, you know very well that for trade receivables, you need to apply a simplified approach to the measurement of expected credit loss. And it means that there is no staging, and you simply recognize lifetime expected credit loss for all financial assets that fall into that category, for that matter, trade receivables, right? Versus where you have other financial assets like bonds and loans and all of that stuff, you need to apply general approach where there is some sort of staging, and you recognize 12 months expected credit loss or lifetime expected credit loss depending on the stage. And here where COVID comes. So at the end of each reporting date, you absolutely have to assess whether there was significant increase in credit risk since initial recognition, right? I need to stress that because I've met many people that are making a mistake here, that they are assessing if the credit risk increased since the last reporting date. It's not true. I mean, if you generated loan 3 years ago and this loan now is kind of impaired because the debtor is not able to pay, you are assessing whether the credit risk increased since 3 years ago to this date, not since last reporting date to this date, right? And COVID very much affects assessment of significant increase in credit risk. So that's the first area in ECL where you should be absolutely careful when looking at expected credit loss from the point of view of COVID. Why? Because COVID and its measures may result in assets being modified, right? So there could be reductions in interest rate. There should be some grace period provided by the banks. Even I've heard that governments sometimes may mandate lenders to defer payments. Like in our country, for example, that was the case when our government, made order to our banks to give a grace period to people for 6 months, so people don't have to repay mortgages for 6 months, and then they will continue in repayment after those 6 months, right? And you would say, okay, so no payments are happening for 30 days, and there is rebuttable presumption that if the payments are due for more than 30 days, then there is significant increase in credit risk. This might not be the case, right? So if this is mandated by the government, you have to assess it in that light, okay? So that's where normal conditions don't apply. Now, I would like to mention also a few words about measurement of expected credit loss itself. As far as I know, many companies and many entities use Basel II methodology, right? This is not required by IFRS 9, but it's mostly used. In very short, it calculates expected credit loss as exposure at default, multiply with probability of default, multiply with loss given default, right? It's very known formula, and in fact, it's coming from Basel II. So exposure at default, it's clear. I mean, it's how much your debtor owes you that isn't affected by the COVID that much, unless he doesn't repay, all right? But let's not speak about that. But what about probability of default? You might need to redefine default, right? Because I need to stress that IFRS 9 does not define what the default is. It doesn't tell you. And it tells you in its guidance that you should define default based on your management over the practices of your managing of credit risk, all right? So some banks define default as being 120 days overdue, and some entities define default as only when a default event happens. Thus, for example, debtor already goes bankrupt, right? And COVID might really trigger the need of redefining default, because being 120 days overdue in COVID times might not necessarily be like default event, right? Then I would like to mention also historical information, and this applies mostly when you're working with trade receivables or any other portfolio, big portfolios, when you're going to use provision metrics or something else for calculation of bad debts. So it's more or less related to the collective assessment. So do you think that historical information will be valid here? I mean, not really. We shouldn't rely on historical information that much because, I mean, we haven't lived this before and we haven't gone through this crisis. No one before was ever forced to close the business for a few months, right? So yes, we can take historical information as some sort of basis for the calculation, but we must make absolutely sure to incorporate forward-looking estimates, forward-looking information, because it's almost 100% sure that most of your debtors will not perform as they performed in the past. All right, then there is an impact of government measures, of course, right? And I have mentioned that already. What about loss given default? This will be also affected, especially by the collateral value, right? Because collateral, it's something backing up the loan. And imagine, as a result of some market crash or whatever, the value of collaterals can go down. There could be the crash on the real estate market, right? And the value of the buildings or of the property backing up the loan might go down. So banks will have to make adjustments into their models to, I know you mean kind of adopt loss given default based on this collateral value. Also, I mentioned it. I mentioned the government support as well. Here, I'd like to mention also one more point to this. I would like to say that I've heard people saying that, all right, so you're closing shops, you're closing these fitness centers, you're closing restaurants, and you know, but it's not really that significant. I mean, it will not impact the economy and all that stuff. Well, I need to say that in most countries, GDP is created by small and medium enterprises. In some countries, the share of SMEs on GDP is something like 40%, and in some countries, it's even 60%. So I would be careful about, you know, not saying that, all right, these small businesses don't matter. They do matter. They do matter a lot. All right. Let's go to the measuring of ECL itself. Now, IFRS 9 requires using unbiased probability weighted amount, and that means that it requires to evaluate range of possible outcomes, right? So what you should do is to identify possible scenarios and specify the amount and timing of cash flows and estimated probability of each scenario. Well, what I mean is that at least you should consider two scenarios, right? You should consider that credit loss occurs and that credit loss does not occur, right? So in these COVID times, it's especially very, very important to do this when you are measuring credit loss on individual receivables, because it's very hard to apply that in the portfolio on the collective measurement, but for the individuals. Let me give you a very, very short illustration. So let's say the debtor owes you 1,000 currency units, whatever, right? And then you're going to think of, right? First scenario, the government closed the shops and everything, right, because of COVID. So first scenario is that shops open in 1 month. And in this case, you estimate, all right, this debtor will do okay. He can afford to lose 1 month of revenue. So loss given default will be 0. You will not lose anything. He will be still able to pay you. But the probability of this scenario is just 10%, all right? So ECL is 0. Second scenario will be that government will open shops after 6 months, right? And in this case, the debtor will have troubles and will not be able to pay you in full amount. So you estimate that your loss given default will be 30%. And this scenario, based on past experience from the last year, is 70% probable. So if you multiply all of that, you will lose 210 currency units. And the third scenario is that shops will open in 1 year. Loss given default will be 90% because you will not lose anything because you assume that debtor, all right, he will not pay you, but he will be able to sell some of his assets and give something back to you from your debt. And this probability is 20%, so your ECL will be 180. And the total weighted probability, weighted amount will be 390, right? So this is the way of assessing multiple scenarios. Of course, I just made it up, and I know that these probabilities like 10%, 70%, 20%, it's just, this is very challenging to estimate. You don't know, right? We don't know, and auditors don't know. But I must say that it's better than nothing, right? And it's the way of working with our best estimates and best judgment as we can do to reflect this very, very uncertain situation. All right. Now, let me mention a few words about incorporating forward-looking information. As I've said, that historical information are no longer reliable because we just know for sure that we're not going to continue as before. And the past performance is absolutely irrelevant in many, many cases, in many, many businesses. So what you should do here is identify factors that impact credit risk of the financial assets in question, right? And I must say that at least you should take gross domestic product and its movement into the account, because GDP kind of reflects the state, the general state of the economy, right? But you should not use it as a single factor, because it's extremely volatile during these COVID times. And I must say that often changes in credit risk do not correspond in changes in gross domestic product. Why? Because for a huge fall of GDP, there could be only a small additional change in credit risk. And after certain level, if you have like 90% credit risk, then the credit risk cannot increase more, right? So you must also use some specific entity, specific factors like commodity prices, right? Based on the entity and based on the industry where it operates. How you should identify these factors? So many banks issue their annual reports, financial statements, where they tell you what factors affect which industry, right? Also, there could be general factors of the environment of your debtors, could be published by, by the government agencies. So you should be really able to identify credible forecasts of these factors that are affecting that business in question, right? As I said, good sources are government finance ministries, central banks, your bank, official statistical agencies, World Bank and IMF are good sources, and you should update this information at least annually. Good source of information for assessing your probability of default and other inputs into the expected credit loss valuations are ratings. Just very shortly about that, rating is a combination of letters, numbers to reflect risk, and as we know well, there are three major rating agencies in the world, which is S&P, Fitch, Moody's. And I must say that these rating agencies, they issue ratings by country and by industry, and they have really, really detailed data in their database. Some of it is freely available, but they require free registration. Some of it is behind their paywall, so you might need to pay for this information. And by the way, I make no financial interest in promoting this whatsoever. I'm just quoting my own experience on that, right? So ratings are good source, especially I like Moody's, because Moody's publishes ratings for the countries, and they also give you the equivalent factor for credit risk. So for example, if we have AAA rating for Moody's, then the factor for forward-looking information credit risk is 1.1 as an example. And it means that if the historical through the cycle loss on your receivables was, for example, 10%, then you need to increase it by 1.1 factor to make it 11.1%, and thus you incorporated forward-looking information based on rating, right? It's possible. So These are just information on what rating categories they have. S&P and Fitch use AAA to BBB, Moody uses AAA to BAA, and then they specify, I mean, movement from one rating category to another rating category, like from AAA to AA, is called notch. And sometimes even one change in notch can mean huge change in credit risk. And if you go to these sites and look for the information and look for the factors that are connected with ratings, you will see that yourself, right? That AAA has a factor of 1.1, while AA, which is one downgrade, can have factor like 1.5 or so, which is quite a big move. Okay, so, whoops, sorry. I'm not really friendly with that. What happened? Sorry. I need to fix this. Okay. Excuse me. I'm not really technical, so apologize. So now I'd like to mention something to close the topic of ECL. Credit models, credit modeling. To incorporate forward-looking information into the historical information, especially to portfolios, you might need to work with credit models, with credit modeling. And here I'd like to stop. Many banks have their own credit modeling departments, and they have amazing credit models. They're working on them, and these models, they can be anything from Monte Carlo simulation, Markov model, Vasicek model. A lot of different sort of models apply in many different situations. And the aim of these models is to find the correlation between your credit risk and between the factors that affect the credit risk. So for example, if unemployment affects the credit risk of your receivables, then how, right? What is the number? If the unemployment changes from 10% to 15%, how? What is the number, the equivalent increase in credit risk? So this is the aim of credit models. I'd like to mention here that this is a particular difficulty here if you have trade receivables and if you're trying to develop your own credit models, because number one, you need to have extremely good expert in the company who understands that. And I must say, I'm an accountant. I know IFRS, but I'm not an expert in credit modeling, although I learned it sometimes, but I wouldn't be there to develop credit model. And number two, this is the particular area where auditors may step in and they should require good explanation of the credit model and how it works and how it develops these correlations. So, however, there is a solution for that. I've seen that on internet, there are several companies who sell models measuring credit risk, and they require online subscription. And for listed companies, so if your company is listed, they have ready-made measures because they take the information from their published balance sheets, from the stock exchanges, and so and so. But for unlisted companies, if you have unlisted companies in your portfolio, then they might require some input information. And I need to say that how these vendors operate is that they usually buy very, very expensive subscriptions to Moody's, for example. And I know that it is really tens of thousands dollars or euros or whatever currency you want to use. And they really work with this data from Moody's. They work with your own industry, they work with the country, and then they are able to develop their own models. So basically what companies like who want to incorporate forward-looking information, what they really do is just to, you know, pay them the fee, give them their portfolio of trade receivables, and they get a full report. Maybe I'm not going to promote any of it. I'm just letting you know that if you have troubles to calculate, you know, expected credit loss on some portfolio of receivables where forward-looking information is extremely difficult to extract and to incorporate, then these vendors of these models, I mean, I know it will cost something, but it will be, number one, it will be more acceptable to auditors because these you would get the full report, and number two, it will just take off any care about this from your shoulders. So maybe this would be the option for you unless you want to develop the models yourself, right? All right. So the third topic I want to talk about is impairment of assets, which was already mentioned here. Again, my favorite screen, yes, everything is closed, pandemic, and so and so. So what you should do, we know that very well. At the end of each reporting period, we should focus if there is indication of impairment. Oh, and yes, there are many indications of impairment of assets out there. So first of all, there were limitations to produce, right? Of course, you know very well that because of these COVID measures and all of that, there are inefficiently working supply chains. There can be disruptions in supplies, right? That could cause some idle capacities. Also, there could be some internal obstacles to produce, like quarantine of employees, or in some countries, they have a limit of number of people per certain area, right? There could be increased cost of productions because the companies might need to introduce some hygienic measures, something like disinfectants and, you know, face masks and, you know, all these hygienic measures to, you know, to keep the environment safe. Of course, there could be also limitations to sell that are also strong impairment indicators. Closures, for example, airlines. Did you know that airlines declined by 90% because of these COVID measures? And unless they get some big government bucks to support them, they will not. I wonder how they will able to make it, right? Also, customers, they require discounts because the customers are also in the worst financial situation, and really the businesses are forced to provide discounts. And then there are some market factors, and by market factors I mean more or less the indicators of impairment of goodwill, because if the market prices of shares decline, then automatically you have lower capitalization in terms of number of traded shares times market price. And if you have a lower capitalization, then it means that the goodwill might be impaired. Although I must say that globally there is very strange situation on the markets, because despite GDPs declining and all of that, market prices are still very high. Stock market has not seen any crash yet. There were some smaller correction, but it bounced back. And well, I'm not an expert on that, but many experts that I follow and monitor and I speak to, they say that it's because the US, especially US government, who has the US dollar is a reserve currency, and Fed is printing money, and this excess goes straight to the stock market. So you have the explanation there, right? Some sort of. But who knows what will happen in the future, so we must watch out. Some experts say that the market crash is imminent and coming at some point of time, right? So I really don't know. But market factor would be the big factor to watch out for goodwill impairment. Not happened yet, but I suspect it might happen in the near future. So how we are going to do this? As soon as we have indicators for impairment, we have to test our assets for impairment. Of course, when you have intangible assets like goodwill, you don't have to have any indicator of impairment. You have to test goodwill for impairment each year. And I need to stress here that you should not also forget right-of-use assets that you have in your books due to leases, right? So as soon as you have leases and you have capitalized some right-of-use assets, then you have to test also these assets for impairment, which is extremely important if you're testing for impairment with cash generating units, because then you must add the ROU assets to your cash generating units, and automatically it increases the carrying amount of that unit, right? So just a small revision, how to perform impairment test. Well, we know very well, this is very quick. Asset is impaired when carrying amount is greater than recoverable amount. Carrying amount is what you see in your books. Recoverable amount, it's fair value less cost to sell, and value in use, whichever is greater. And of course, difference between these two is impairment loss. Now, let me stop by the recoverable amount, okay? So recoverable amount, as I've mentioned, it's higher of assets cash generating unit, fair value less cost of sale, or value in use. In this COVID and post-COVID situation, fair value less cost of sale will be extremely difficult to determine, right? Anyway, let me make a few remarks to that. You should always keep it in line with IFRS 13. So don't forget to put number one sources first, like market prices, then level 2 inputs, and then level 3. Level 3 is all these discounted cash flows and sort of stuff, some surrogates. But as soon as market prices exist, you need to use market prices, right? You should reflect current market conditions. So, I mean, I don't care what was the market price like 3 months ago. I mean, we are now, right, at the time of test. And of course, you would take general price level, compare prices with similar assets and all that. Now, let me focus on value in use, because this is what most companies will use for their impairment tests. And this is also the area which could be easily manipulated and where auditors would have to step in and really revise it very, very carefully. I was auditor myself, so I kind of know the situation well. So in value in use, you absolutely have to make sure that you have appropriate cash flow projections, all right? And what to include in cash flow projections? Of course, cash flows from assets continuing use, cash outflows that are necessary to generate cash inflows from assets continuing use. So you're not going to add planned enhancement, right? Okay, so I'm planning to, you know, install new functionality. No, this is excluded unless there is restructuring to which you're committed. And then you're going to include net cash flows from asset disposals. And again, similarly, as I mentioned with expected credit loss, also here, you have to use multiple scenarios with probabilities of occurrence of weights, right? And again, I will give you the illustration on the next screen. Just let me mention a few factors that you should consider. So when making cash flow projections, especially COVID and post-COVID times, you have to consider effect of government measures to prevent the spread. So again, are we going to have decreased revenues as a result of closures of businesses, right? Then you have to consider increased cost of operations, right? And I'm here again, do I have to purchase, you know, hygienic stations to operate my business? Do I have to purchase respirators, face masks to everyone in my business to operate? You have to consider expected compensations of lost revenue. So if the government is going to compensate some businesses, then you should count with that if this is reasonably certain, right? Maybe strength of competitors. Are they going to survive? If they're not going to survive, will I experience higher revenues? And of course, change demand on the market, of course, especially airlines and travel industry. There will be no demand on the market, right? Who wants to travel these days? Only the persons that have to travel. So let me give you, short example, again, about multiple scenarios and how to think about it. It's very similar to what I showed you before. So let's say that we have a situation where government closed all fitness centers for an indefinite time. And based on past experience, Fitness Network assumes 3 scenarios possible. Number 1, reopen after 1 month, 50% capacity. During pandemics, which will be 1 year, 20% probable. Number 2, reopen after 3 months, 50% capacity, 70% probable. And number 3, close during pandemic, 10% probable. And let's say that in number 3, whenever it is closed, then the government will give you some compensation, right? So we have our 3 scenarios here. I have estimated the cash flows under all of these scenarios, and I have weighted these cash flows with probabilities. And here I came with some expected value, which is minus 125,000. Again, it is huge uncertainties there. And yeah, auditors will ask you, how do you know? Why 20% probability? Why not 30%? Why this, why that? This is best representation as you can give me. This is what happened last year, and maybe we assume that this will happen this year as well. And remember, this is just expected value of cash flows for 1 year, right? and you still have to add 4 more years because you should do the cash flows for 5 years, and thus you would arrive at the value in use. So no, this is not your value in use. What else you should consider? As I've mentioned, forecast period is 5 years. Now, you also should consider terminal value, and it's funny that when I was revising many, sort of value in use calculations, some companies even forgot about it. And terminal value, sometimes it creates 50 to 80% of value in use. What's that? Well, terminal value represents amount that will be gotten from business or from the asset for the periods beyond 5 years. Because while you can forecast for 5 years, then you cannot forecast beyond 5 years. And this is also that IAS 36 kind of not prohibits that, but doesn't recommend requiring cash flow projections beyond 5 years, right? So there are a few methods of how to calculate terminal value, if even either it is, for example, exit multiple, or is it perpetuity, or some other sorts of method. I have an article on my website on this, so you can go there and it's free. I mean, you can read it. So terminal value will be the amount very much impacted by COVID, because again, it depends on the market, on the situation, and there is a huge uncertainty there. And of course, discount rate, I have to mention here that discount rate should be the same for each scenario that you use, all right? So huge challenges in dealing with crisis. Now, let me give you, because I think that we are running out of time, I still have a few minutes, so I would like to mention a few words about accounting for gold and accounting for cryptocurrencies, right? Why accounting for gold? As I've said, gold is considered safe haven investment, and not only gold, it's also other precious metals like silver, platinum, and I don't even have to mention gold in India. I know it's very popular in your country, and India is one of the biggest buyers of gold worldwide. And I need to say, some people used to say that gold is God's money and Bitcoin is people's money, because gold is God's money because it's extracted from the ground and God gave it there. And Bitcoin is something that is created by the people for the people. Well, whatever, this is very poetic. I'm mentioning gold here because, as I mentioned in the beginning of my speech, in these times, it's perhaps the oldest investment in the world. It has been used as money for 5,000 years. All the currencies in the world were backed up by gold at some point of time, right? It was cut off of US dollar, I think in 1971, there was finally cut off, 73, I'm sorry. So not for the last 50 years, but before that, the gold was backing up the currencies. It is solid currency. And nowadays, many people, but also investment and pension funds, are fleeing to gold to preserve their wealth, right? The problem with accounting for gold is that there is no specific standard dealing with precious metals, right? And really, the challenge here is that we cannot use IAS 32 IFRS 9 because simply gold does not meet the definition of a financial instrument. If you recall, financial instrument is a contract. It is the contractual agreement arrangement between two parties, right? Financial asset at one party, creating a financial liability or equity instrument in another party. This is not the case. You have no counterparty when you have gold, right? It's just gold, it's just a piece of metal. And also I need to say that some people say, all right, so let's use IAS 40 investment property. But I mean, gold does not meet the definition of investment property either, because in the standard IAS 40 is here for lands and buildings that you're using for capital appreciation or for rentals or for other purposes or for both purposes, right? And gold is nothing like that. Sorry. So what to do? Oh yeah, it's true that IAS 2 says something about it, but it's more or less applying to commodity brokers and dealers, and they should measure their inventories at fair value less cost to sell and recognize changes in fair value of these inventories in profit or loss. But it only relates to commodity brokers and dealers, right? it doesn't kind of relate to you, to other bodies, to the banks, to pension funds who don't deal with it, who just buy it for the purpose of their storage of wealth. So when we have no accounting policy, then what we should do? IS 8 says that we should develop our own accounting policy. So, and this is again what's happening. Many companies, many investment funds that are starting to invest in gold, they are starting to develop their own accounting policy. And also IS 8 says where we should look at when we're developing our own accounting policy. Should we look to the IFRS about similar issues? Then we should look to the conceptual framework, and then we should look to other financial reporting rules, guides, etc. And I must say there is a hierarchy. So if, for example, some other financial reporting rules are in contradiction with IFRS about similar issues, you should put priority to IFRS about similar issues, yeah? And then to conceptual framework, and then to other reporting rules. Okay, so let me shortly give you some hints about that. Characteristics of investments to gold are it has indefinite useful life, definitely, right? It's just metal, and really I've heard that even if the gold, it's very stable. It's very stable, so it has been thousands of years under the ground and it will still be the same molecule. It's almost undestroyable, of course, by some chemical, yeah, but other than this, it's very stable. Then its fair value tends to increase over long term, over time. Of course, there are fluctuations, no discussion on that, but over time, it tends to preserve your value. I need to tell you the example. My grandfather, he used to tell me, he was a very nice old man, and he died when he was about 100 years old. And he told me that his father used to buy a very nice woolen suit, like a pants and a jacket, for about 1 ounce of gold 100 years ago. And believe it or not, but it's true even now, for one ounce of gold, you can buy exactly the same nice suit also today. And this is very small illustration of how gold keeps its value over time, and its nominal value tends to increase over time. And the purpose of its store value and for capital appreciation, well, if that's the purpose that you're buying it, or the investment funds are buying it. So I would say that fair value model under IS 40 is perhaps, the best suited for this situation. Although gold, as I've said, it's not an investment property, but if I would be to develop my own accounting policy for accounting for gold, I would perhaps say that, okay, fair value model based on these characteristics applies the best. So initially you would measure it at fair value, and subsequently also at fair value with changes in profit or loss, all right? Of course, if you think that you can develop your own accounting policy, if you ever encounter this problem in your clients' accounts or in your own accounts, then I would perhaps think of this. I must say, to close this topic, there is a World Gold Council. I'm giving you the website here. It's the organization that gives you the information about investments in gold, and they have the accounting guide that they issued. But I would say that this guide is not very suitable for regular companies. It's more or less suitable for monetary authorities like central banks that have the reserves in gold, because they're required to book the changes in fair value of gold to other comprehensive income, which is not really resonating with my thoughts about it as a preservation of, wealth. Right. Last topic I have to cover very quickly, we're running out of time, sorry, is accounting for cryptocurrencies. And here, it's not a new issue, I would say. It's been here for a while, and cryptocurrencies, along with gold, are becoming, another mean of storing the wealth. Although I must say it's still very progressive, and I haven't seen many companies as such investing to cryptocurrencies. Well, Tesla in America, maybe Elon Musk, then they claimed that they invested something like 1.5 billion US dollars to Bitcoin. And as a result of that, the price of Bitcoin shoot up quickly. On the other hand, I must say that these cryptocurrencies, they are not very favored by governments, by countries, because they cannot control them. The thing is that the cryptocurrencies are very decentralized and central banks cannot put their hand on them. It's very hard to control them, and therefore countries are banning them. As far as I know, about 2 weeks ago or 3 weeks ago, don't remember exactly, Turkey was one of the countries that put the ban on trading with cryptocurrencies. I know that China has the restrictions, but still there are many countries that have their currencies not really convertible, like Venezuela, Iran, and many other countries. And they are even investing in their own systems to mine the cryptocurrencies, because they plan to use them as their means of exchange. So I don't think that we should be ignoring this. And we should look at it from the accounting point of view. All right, so what is cryptocurrency? Again, very quickly, it's digital currency designed to function as a medium exchange, but it has not the characteristics of a currency. Right? Why? It is decentralized. So I must say there is no legal tender, there is nothing like the organization or the bank that issues the cryptocurrencies. And these are just a list of transactions recorded on a distributed ledger, and this ledger is called blockchain. All right, and I will very shortly, very shortly describe how it works, just because you need to understand it to decide how to account for them, right? I will mention it. So we have many transactions that are going on. They are organized into blocks because these transactions are they are multiple, right? And the blocks, there are blocks after block after block, and these blocks are connected to each other with some cryptographical means, right? And cryptography is used to maintain security and prevent fraud, right? So this is called proof of work, or it's called also a hash. And hash is something securing that, okay, these transactions are regular and valid, and there is no fraud going on in the network. Okay, this is all I would say you need to know about that. What I said, it's not a currency. Although it can be used in exchange for some goods or services, this is not widely accepted, and it's not used in a monetary unit in pricing goods or services. So yeah, you can see sometimes, all right, we are selling this for Bitcoin, but the amount of Bitcoin is basically tied to the amount set in another legal currency. Okay. So it's never used until now as a measurement basis in the financial statements. There is no contract, no counterparty. So we definitely must say that based on this reason, you cannot account for it as for financial instrument. And I must say that this view is also supported by IFRIC decision dated in June 2019, right? So what happened then? IFRIC said that cryptocurrency is an intangible asset. And now I am talking about cryptocurrency in the accounts of holders. So when you have a client or yourself, you buy Bitcoin, buy whatever cryptocurrency, you are a holder and you effectively bought intangible asset. Why? Because according to IFRIC, it meets the definition of intangible asset. It is identifiable non-monetary asset without physical substance. If it's held for trading by cryptocurrency dealers and brokers, then you're going to use IAS 2. And you are going to apply the same paragraph as to accounting of gold that I mentioned, all right? So you're not going to keep this at net realizable value lower of NRV or cost. You're going to keep it at fair value with changes in profit or loss. If you hold it for other purposes, as I mentioned, for appreciation or storage of wealth, then you're going to apply IAS 38, right? And here there are many considerations whether you should apply revaluation model or cost model and stuff like that. I have a good article on my website about this topic. It's free. If you're ever interested in this topic, then just visit cpdbox.com. You will find it there. And I must say that all cryptocurrencies, they have indefinite useful life, and you would not book any amortization. The problem, which is not covered anywhere else, and this is the question that I'm getting many, many times, is how to account. Oh, sorry again. I should stay away from clicking. How you should account for cryptocurrency if you are a miner, right? Because a lot of companies are mining, they are creating this cryptocurrency. And I must say that by no means you're going to apply IFRS 6, exploration and evaluation of mineral resources. Especially this is also the question that I'm asking. We are miners of cryptocurrency. Does it mean that we have to apply mining standard IFRS 6? Hell no. Because, and this is exactly why you need to understand what miners are really doing. Because if you understand what they are doing, then you can decide what how they should account for it, right? So what are they doing? There are, you know, you're seeing these people, there are some, you know, participants in the network, they are transacting where one person pays to another person, and this is recorded as a transaction in the ledger, right? And again, another person pays to another person, transaction 2, transaction 3, and these transactions are happening multiple at the same time. And then there is a block that is created, and there is the proof of work, right? And also, this ledger is decentralized, so it means that all participants of this network have the same copy of that ledger. Okay, this is very important to mention. And what miners usually do is that these miners they are validating transactions, and they include them in one block. And but them validating the transaction means that they are adding proof of work to this by cryptography. They are especially solving cryptographic puzzle. So for this, they receive transaction fees as a reward. The second thing they are doing is that they are, sorry, I cannot see that. They are creating blocks. They verify them and update the ledger, the blockchain. All right. Sorry again. And for this, they receive block reward. And now big question is how to account for these transaction fees and how to account for block reward, right? So for block reward, again, as I said, to create valid block, miner needs to guess the correct amount of proof of work. And this requires a lot of computational power, graphic cards, energy, all of that. And in fact, this is called mining, but miner does not mine anything. He provides a service, okay? He provides a service to the network. So as he provides a service, you might ask, okay, so are we going to apply IFRS 15? Well, no, because block reward is paid by the system algorithm. And as such, there is no counterpart, there is no customer in this case. So you cannot apply really revenue from customers, contracts with customers, because you have no counterparty here. There is no contract, okay? And this is also not enforceable. So you're going to apply just the conceptual framework, and you're going to account for this block reward in profit or loss. So you're going to debit intangible assets or inventories, right? Because you're holding new Bitcoin, and you're going to credit your income in profit or loss. Now the transaction fees, so as soon as you pay anyone with Bitcoin, then the miner will take a small portion of Bitcoin as his fee. It's like a banking fee, it's just a transaction fee. And in this case, we can say, all right, it's paid by the originator of the transaction. So it's not by any system algorithm without a customer. There is a customer, right, who is originator of a transaction, and contract is implied, because it's just the rule of the algorithm that everybody understands. If I pay you with Bitcoin, I will pay a small fee in Bitcoins to the, you know, to the miner who validates the transaction. So here IFRS 15 applies, and you're going to include it in profit or loss as the miner becomes entitled to the fee, because this can be deemed as a transaction satisfied or a performance obligation satisfied at the point of time. So again, the same thing. Last point I want to mention here, expenses incurred by the miners. This is again very huge questions I'm receiving. All right, we are miners, and we we use loads of computational power. We have loads of computers, lots of staff, graphic cards, electricity. How do we account for this? Can we capitalize it as an intangible asset because we are creating a new Bitcoins? No, you cannot. And why? The miners, they compete to solve an algorithm first, right? So they are guessing, and they have loads of successful and unsuccessful attempts, right? And it's very difficult, if not impossible, to separate costs for successful and unsuccessful attempts, okay? And also, as we say, they provide services. They do not develop intangible asset, even if it's eventually the result. So we cannot say that we can apply IAS 38. Miners cannot capitalize these expenses, but they should include them in profit or loss as incurred. And absolutely last comment that I'm going to make here. As this Bitcoin and other coins are very popular, a lot of miners are involved, and more computational power is required, and these miners cooperate, right? So you have to also think about applying IFRS 11 if the miners are working in pools of miners, right? Where 2 or more miners work together, and they like create one Bitcoin and they split it. So here, something like joint arrangements apply, and you might need to account for this under IFRS 11. So, I mean, this is all for me. I really hope that you enjoyed it, that you gained some insights from what my readers ask me, what we solve together worldwide, including India, I must say. I have a lot of readers from India and a lot of clever people there. And once again, let me thank you for having me on this conference, and just drop me an email if you need to learn more, if you want to get in contact to me. This is my website, cpdbox.com. Drop me a message and I'll get back. So thank you. Hello.
Yeah, thank you so much, Silvia. Can you please come back to camera mode?
Sorry. Yeah.
Can you please come back to camera? Yeah, I know you have to switch the computer to come back to your original place.
I will try. Give me 2 minutes, right? Because it's extremely difficult right now. Okay, give me a minute, please.
I think it was a fantastic sharing of one of the most important topics. And practically, when I look at the last few points, I think one was on the accounting for cryptocurrencies. I think one of the most difficult, most complex and emerging issues. And there are a lot of things to be done for accounting for cryptocurrencies. And as far as accounting for gold is concerned, I think India, we all have a lot of gold across the region. But if you talk about the accounting of gold, I think this provides a completely different perspective as far as accounting is concerned. And yes, she talked about a very important things like ECL, the competition of expected credit loss model. Because in this COVID situation, one of the most important thing is about computation of the PD, probability defaults, and that is something which is very critical, very crucial. So she has rightly discussed about the ECL model, impairment of assets, and going concern, and very critical is a gold and cryptocurrency. Like Silvia, super wonderful analysis. And we have few questions. So I think you can see on the screen board there's a question by participants, and there's one question by me also. But I think first we can look at the question by participant. You can see the screen.
I'm trying to. I hope you can see me.
Yes, we can see you. Don't worry. Okay, fine. So question is, if COVID losses are quantified as an exceptional items, then whether windfall gains like less traveling and electricity cost or any other cost savings which are not incurred due to pandemic, then shouldn't those gains also be disclosed as exceptional item to give investors a clear picture of profit after tax?
You're okay. So you're asking me. Sorry. Can I hear the echo?
Yeah, please. Yeah, please.
A minute, please.
CCM sir, MD Vijay Kumar sir, thank you so much for coming here, sir.
Is it better?
Chintan, please
Yeah.
let
Yes.
the session.
Yeah. Silvia, please.
What? Sorry?
Yeah, the question was that
Question.
yeah,
I see.
COVID losses are quantified as exceptional item. Now the income, income like cost saving because of electricity and other costs, can it also be taken as a part of my exceptional item, or it should be shown as a reduction in cost separately and losses as a separate exceptional item?
Yeah, I mean, this is the way of presentation. And as I mentioned, this is in the big discussion currently in ISB about the presentation. And as current rules apply, there is no exceptional item. IS1, I must say that a few years ago, I mean, many years ago, you needed to report exceptional items like earthquake or whatever separately, but they canceled it because they say that this is a part of regular business risk. And as it is a business risk, then, you know, it's a part of your operations. So there were these exceptional items in IFRS, they were completely removed. And the state is like this, as I'm saying, right? But yeah, this is exactly the challenge that needs to be addressed by ISB. And I'm fully in agreement with you that if you're going to report some items as a result of COVID, then you should be consistent and take it away as a result of to one line, right? But currently, IS1 does not permit exceptional items. I'm sorry, currently, right? But they will change it. I'm sure they will change it.
Yeah, exactly.
Yeah.
I think these are the very new issues, and we need to really get some more guidance from ISB because exceptional items about losses and income both are very difficult. Another question is that, as you mentioned about the very new emerging areas. So, question for participant is that, can you explain a little bit more on revenue recognition by miners of cryptocurrency?
Right. So as I mentioned, I mentioned only Bitcoin, right? I tried to give you the overview only on Bitcoin because, as you might know, there are many other coins like Ethereum, Ripple. They call it shit coins. I'm sorry for this term, but you know, there are many other cryptocurrencies that they don't have qualities of Bitcoin, and they are working under different mechanisms. So Bitcoin works based on proof of work. And if you want to account for revenue for miners of Bitcoin, then you must need to look what are they doing, right? So for Bitcoin, they're doing two things, miners, all right? They are validating the transactions. So if you pay to someone with Bitcoin, there is a miner who needs to validate that transaction, all right, this really happens, and include it in the block. For this, they get the transactional fee, the transaction fee, and this transaction fee is paid by you, right? You're buying something in Bitcoin, you pay also that fee to the miner. And here IFRS 15 applies. We can say that, all right, this is the performance obligation satisfied at the point of time. So you recognize the revenue as soon as you get the transactional fee. And what's the other part of the entry? So the revenue is credit, but debit, it's intangible asset, basically. I've said, because you're also becoming a holder of Bitcoin, right? You cannot debit some kind of cash or something, because I said Bitcoin is not a financial instrument, it's not cash. So you're going to account simply as debit, intangible asset, or inventory based what you do with that Bitcoin. Are you going to hold it? Are you going to sell it? Whatever, right? And credit revenue. Then there is a second part of the transaction, which is a blockchain reward. And we know that as new Bitcoins are created, the blockchain rewards always halve. I don't know how much is that. Is it 6.5 or did it help? I don't remember how much is that now. But the blockchain reward is given to the miner for guessing the algorithm for creating the block, right? And it's not paid by anyone. It's just new currency created. It's just new Bitcoin out of thin air, we can say, right? So this creates the situation where you have no counterparty, right? You are just, you know, miner who created Bitcoin out of thin air. by the algorithm. So here you cannot apply IFRS 15 by definition, because IFRS 15, its name says it's the revenue from contracts with customer. You have no customer here. So what you're going to do is just, you know, apply common sense and apply conceptual framework for financial reporting in this case. And you're going to account for revenue as soon as you get it, right? And simply the same way, debit, you know, intangible asset, credit revenue in Bitcoins, in valuation according to the market situation, right? Whatever Bitcoin costs in the market. That's very simple. Unfortunate part of miners is, I would say, expenses. This is the problem, because miners don't have usually problems with accounting for revenue, right? They just account for revenue when they got it. The problem is expenses, because they incur huge computational power, computers, graphic cards, electricity, people, all of that. And these expenses must be currently accounted in expenses as incurred. So you cannot capitalize them as an intangible asset, no. Because you cannot really, it's a development. It is the development of an asset, but because you have a lot of unsuccessful and successful attempts, right? The calculations, you cannot really attribute which calculation was successful and which was not successful. And all unsuccessful, they're just pure costs. So I'm sorry, miners, they have to account for expenses straight in profit or loss when incurred, right?
Yep.
What else?
Yeah, I think which you have given is absolutely fantastic presentation, because this is a very new area, and I expect that ISB should come out with some guidance or some IFRIC with respect to this particular issue, because this is what is required. And one more question, I think in our chat box there are many messages of excellent presentations are flowing for you, and there is one more question also. The question is such that in case of going concern not being valid due to COVID-19 and lockdowns, would not the entity then prepare financial statements on realization basis? Under the general framework, would not then all non-current assets be presented as a current assets on realization basis?
This is quite, again, I repeat what I said. It's not very clear. It's just not very clear what you should do. And I also believe that at current state of standards, it's a point of discussion and of different opinions, right? And I said that you call it realization basis, I call it breakup basis of accounting, liquidation basis. This is what I was referring to. You can use it, of course, and you have to say, you have to quote it. That, okay, this is my policy choice because this is what I believe, that I'm not a going concern and I just cannot keep my assets as a non-current anymore, right? But again, it's again the matter of, you know, applying the standards to the best of your knowledge, unless there is some guy from IFRIC coming up and saying, okay, guys, we met and we give you this guidance because I'm sorry, this is, you know, I believe that this is why I mentioned it's accounting challenge, because we don't know, right?
Yeah. So I think there are a lot of questions on your cryptocurrency. I feel personally we want to invite you especially for accounting for cryptocurrency in future again. Hope to see you soon again, Silvia, because everybody is so much eager to listen to you, listen to understand about your thought process on this new emerging area. And so nice of you to have here. Again, special thanks for accepting my invitation to come here. I request my council colleague Vikas Jain to offer a word of thanks.
Thank you, Chintan. Silvia, I must say that this had been a wonderful presentation, and the kind of compliments that are pouring in itself shows that it could not have been better, I would say. So a heartfelt gratitude and thanks on behalf of all our members for the wonderful presentation, and our chairman Harit Dhariwal is also listening to it eagerly, and I'm sure that he would like to invite you for one more session for our members, and as Chintan rightly said, for the cryptocurrency especially. And you have brought a whole new dimension, and the way you explained it has been so practical and pragmatic that we have been feeling like as if we are traveling through the entire this. So thanks a lot for being the part of this program, and thank you very much.
I thank you.
Thank you so much, Sylvia. And it's really a pleasure to have along with us the chairman of Account Standard Board of ICAI, one of the most profiled speaker as far as account is concerned. He is none other but CA MP Vijay Kumar ji, Central Council member of ICAI ASP chairman. Sir, I welcome to you this for the Western Indian Accounting Conference. It's our pride, privilege, and pleasure to have you here. I am sure that the participants will get immensely benefited by your experience. I request Vikas Jain, RCM, to introduce briefly the faculty.
Thank you, Chintan, once again. As such, MP Vijay Kumar sir needs no introduction for our members. He has been a Central Council member for the last 2 terms consecutively. He has chaired various committees like that of ASB, Valuation Standard Board, also DAP, that is the Digital Accounting and Assurance Board. He has been the vice chairman to the Expert Advisory Committee EAC, then FRRB and Committee on Accounting Standard for the local bodies. He has been a nominee member to SAFA, Committee on Accounting Standards, National Financial Reporting Authority, NFRA ex officio he has been, then Quality Review Board. He has also been nominee on SEBI Committee on Disclosure and Accounting Standards. He has been members of various other important committees of ICAI that includes Auditing and Assurance Standards Board, Board of Studies, Corporate Law and Corporate Governance Committees. Besides this, he has been member of IFRS Advisory Council. He has been member to SMEIG. He has a vast experience of almost more than 25 years, and presently he has been a director with XBR India Limited, CP Singapore Limited, Tejo Engineering Limited, Sela India Software Limited, and many other companies. He has been former director of National Internet Exchange of India. He has been resource professional to the various programs of the Institute and international programs. He has been teaching the profession of this accountancy for almost 20 years. So the list goes on and on and on. And he has been author to the various publications for the members as well as for the institutes, as well as for the students. So with these brief introductions, sir, I can go for an introduction for maybe another 10 minutes. But thank you very much for the part of this program. Thank you, sir.
Thanks, Vikas.
Yeah, for just a minute, sir. For briefly introducing my faculty, see, Schedule 3 is one of the most important change in this arena. And I was thinking that whom to invite. And when the question comes of invitations on Schedule 3, only one person which come into mind first and only is the Vijay Kumar ji. And he's a person who has been known as an authority on accounting. And something of Schedule 3 changes, if you want to listen, it is only the person who has been behind these changes. So with this brief word, sir, I request you to please share your thought process.
Thanks, Chintan, for the invite and for friendship, which I've enjoyed with you over time. Thanks, Vishal, for the kind words of introduction. Sincere thanks to WRC regional team led by Manish and the Ahmedabad branch managing committee team led by Harit. Thank you all for the invite. I'm not sure if Sylvia is still there, but my hearty compliments to Sylvia for the wonderful presentation. I've been listening to her since 4 p.m. and one of the best articulations I have come across. And the way she explained ECL, the way she explained gold loans, gold accounting, and cryptocurrency. I've always believed that if somebody is able to explain well and in simple terms, it's possible only when the person has a deep subject matter expertise, and that is so very well visible. Congrats, Sylvia, and thank you for taking your time and addressing us. And Chintan, to you for having reached out to her and invited her to address the members. She was outstanding. She was outstanding. So let me come to our session. Chintan, I think I can go up to 6:30, or what's the closing time?
No, yes, sir. Please, you can go ahead whatever time you want, sir. Everybody desires to listen to you, sir. Time is not an issue.
Fine. Okay. Okay. Thanks, Chintan. Thank you. So greetings to all the members who are attending here. Trust all of you are safe and your near and dear ones are healthy. In fact, given the kind of pandemic situation we have, it is very disturbing at times as to whether one should actually even accept invites like this. So it's a debate in your mind. Just a second, let me get these slides up. Is the PPT visible, Chintan?
Yes, sir. It's visible, sir. But
Okay,
we can see we can see the all PPTs, not only one slide at this juncture.
Okay. There's something wrong there. Okay.
Now we can see the first slide.
Okay. Now yes. Is it visible? Oh, great.
Exactly.
Thank you. Yeah. So in fact, during this extended pandemic, I keep debating in my mind as to whether one should accept an invite to address programs like this when people known to you across the country are going through very tough times. But I have on balance tried to reconcile myself that at least these 2-3 hours of learning sessions keep somebody disengaged from what's happening around and helps you to at least get that little bit of mind away from all this disturbance which is happening on. So let's all pray for quick good times to come back. Of course, it's a little far away, but I guess with the discipline which all of us should practice, we should get back to normalcy sometime soon. So as far as the topic is concerned, amendments to Schedule 3, which the MCA notified on 24th March 2021. Before I start speaking on it, a small caveat. Whatever I speak now, it should be read with the text of the amendments. And more importantly, whatever I speak, none of it should be seen as views of the Accounting Standards Board or any of the other committees or of the Council of the Institute. Just for the benefit of all members, you are all aware that we have a guidance note on Schedule 3. Now that these amendments have come in, the guidance note will also be amended in due course. And there are many terms or many points in this set of amendments where a considered view has to be taken. So the view could eventually be what I am articulating now, or some edits might also happen based on the overall wisdom and insights which we will get. Sorry, PPT is again gone. Yeah. So let me set the context, and I have these 3 small messages, but this will be the underlying message in each of the amendments which MCA has now done. It's very important to understand the rationale of these amendments for us to comply with these amendments. I have always believed that the profession of accounting is all about accountability, raising your hands and saying that, yes, I am answerable for what I am reporting or what I am expressing opinion on. And we all know that accounting is the base for taxation, governance, credit, investment, sustainability, and so on and so forth. And more importantly, considering that most of the people who are in the webinar now could be practicing chartered accountants, the opinion on financial statements is a communication. So when you give an audit report, when you give those the CARO attached to that audit report, that report is a communication. And just like in personal life, you and I expect communication to be truthful. In the case of audit reports, the same holds good as well. Everybody expects that the communication has to be only truthful and complete. This gentleman fascinates me. Of course, I came in contact with the quality of work which he has done only in 2016. We all know him certainly, founder president of the institute, late Shri GP Kapadia. But in 2016, I had an opportunity as part of one project in the institute to look at the historical development of the profession. And at that time, I went through lots of literature around what he had spoken and how the institute development happened. And there are these two important lines from his quotes. There's several such fascinating observations from him, but I will highlight these two lines, which will also help us understand in right context the amendments to Schedule 3. He goes on to say that every learned profession should have a sense of social purpose, and more so in the case of accounting profession. I think there's some difficulty. Just a second. There's some difficulty I'm facing in closing.
MD sir?
Yeah.
So, कुछ problem?
Yeah. Okay. Now is the PPT visible? Because
Yes,
the PPT is disappearing for me.
MP sir, अभी आप PPT चेंज करेंगे ना तो माउस का एरो ले जाकर वहाँ पे क्लिक कर दीजिए, फिर आप बटन से चेंज कर सकेंगे. बाहर करते हैं ना तो उसके बाद वो करते हैं तो नेक्स्ट नहीं होता है, इसलिए आपको प्रॉब्लम आ रहा है.
ठीक है. Thank you. And the second important message he gives is that the chartered accountant is a person on whom every member of the society could rely and rely strongly. And these two lines are so very important when we as chartered accountants are engaged either as a preparer of financial statements or as an auditor expressing an opinion on the financial statements. The Ministry of Corporate Affairs issued these amendments on 24th of March 21, where there have been amendments brought in all the three divisions. Division 1, which is applicable for those companies who follow the Companies Accounting Standard Rules 2006. Division 2 is for those who follow Ind AS, and Division 3 is for NBFCs who follow Ind AS. As far as the applicability goes, this revised Schedule 3 or the amendments will apply effective for the financial statements prepared for periods beginning on or after 1st April 2021. Why is the timing of this webinar important for this topic? In fact, many might think these amendments are applicable only for financial year 21-22. Probably we could invest time in learning this and applying this second half of the year or closer to end of the financial year. Let me highlight to you, and I would make a sincere appeal to each of you. Please share this message across all the members that the amendments to Schedule 3 are so substantial that next year when you prepare the financial statements and you give comparative financial information for 31st March 21, all of this amendments related information has to be given for 31st March 2021 as well. And if we do not do a dry run now, while doing the preparation of financial statements for March 21 or the audit for the period ended March 21, there will be lots of surprise elements which the client or the preparer will be unhappy about at a later stage. I would strongly encourage that while the financial statements are prepared for March 21 itself, the implications of these amendments are highlighted to the boards of the companies concerned in a very formal manner so that people are all prepared on this and there is no surprise to them. And as I mentioned earlier, from the Institute, a guidance note on these amendments or Schedule 3 amendments will come sometime soon. This entire amendments to Schedule 3 got triggered by CARO 2020. As all of us are aware, CARO 2020 is substantially different from the earlier version of CARO 2016. And in CARO 2020, what MCA or the government seeks to achieve is to address this expectation gap. All of us speak in every forum possible that there is an expectation gap. We do something, whereas the stakeholders and regulators have a different expectation. CARO 2020 and now the amendments in Schedule 3 is a step in the direction to reduce the expectation. So instead of MCA or government imagining that these things are all in order, now they are asking for a specific assertion of the same. So the moment you assert the same, you are reducing that expectation gap. And my experience of interaction with MCA, while many of us might find the additional reporting requirements, either as a preparer or as an auditor, a little burdensome, let me share with you that MCA has a huge respect for the chartered accountancy fraternity. And they strongly believe that if there is one set of professionals who can actually help them in enhancing governance and in identifying red flags earlier, it's only the chartered accountants. They have that very clear understanding and respect for the accounting profession. And I have pasted below the Ministry of Corporate Affairs tagline. Look at this tagline. Many of you might have seen it, but I thought I should use this opportunity as well to highlight to you what is the theme under which they are working on a daily basis. And every circular, every notification, every amendment, you can actually see this. MCA's tagline talks about empowering business and protecting investors. Mind you, this is the tagline of MCA. And they talk about achieving all of this, being a regulator, an integrator, a facilitator, and an educator as well. I'll spend a few minutes on CARO 2020 because almost all of these Schedule 3 amendments are driven by CARO 2020. So what are the changes and why these changes? As far as CARO 2020 is concerned, compared to its earlier form of 2016, which all of us will report for financial year ending 2021 as well, 7 clauses out of that are retained as is. Another 7 clauses are retained with changes. 1 clause on managerial remuneration is getting deleted. 5 new clauses have been introduced. And there were 2 clauses in the earlier CARO of 2003, which were deleted when 2016 CARO was issued. 2 clauses have been brought in back, and effectively we have 21 clauses, and with sub-clauses, we have 47 sub-clauses effectively to report. It's huge, and let me share with you, compared to the project they originally started off, this is a pruned down list of 47. And based on experience of how the governance improvement is happening, this list might either increase or decrease. If you want the risk to reduce, the governance has to improve overall. If the governance is appearing shaky, the list will only become much bigger in times to come. And all of this in the interest of less government and more governance. So the idea here is, instead of MCA individually going after each of the companies, doing their inquiries and investigation, You make this part of the reporting process itself, where preparers report some part of the information and auditors give an assertion of the same. So the idea is the MCA deals only with exceptions, and if everything is right based on the assertion of auditor, life moves on. And as I mentioned at the start, more trust on the auditors by the government for better governance. And friends, most importantly, it is a very, very powerful tool in the hands of auditors to express an opinion. So more often than not, we all come across situations where the main audit report has its limitations in terms of how much you can describe about what's happening in the company. Thankfully, we have SA 701 now, Key Audit Matters. I'm a huge fan of SA 701 to such an extent that I encourage unlisted companies and private limited companies, also those auditors, to voluntarily apply SA 701. It brings life to the audit report. It brings life to audit report as to what are those key audit matters, why those matters were considered as key, how did you go about satisfying yourself, and what is the satisfaction you've got. So similar to that, you have this Keynote 2020, which is also fairly descriptive in nature, where you give your comments on several matters. So as I mentioned, 7 new clauses have been added. Just look at the left-hand side, the 7 new clauses, and you'll find that the Schedule 3 amendments, all of these amendments have been done keeping practicing chartered accountants in mind. Keeping practicing chartered accountants in mind. For an auditor to report on a transaction which is not recorded in books, it is not possible if the preparer is not having a responsibility for the same. For the auditor to come to a view on whether the company will be solvent, unless there is enough indicators prepared by the management and management gives those indicators, it is not possible for the auditors to make that kind of a opinion. So this entire Schedule 3 amendments which are there is largely in the backdrop of the Keynote 2020, the clauses which are there in Keynote 2020 to help the auditors to express an opinion. The preparers have been asked to make available that information as part of the financial statements. And while revising Schedule 3 for this purpose, there were a few areas where some edits were pending and those edits have been done. For example, Ind AS 116, lease liability, where to present it. The earlier Schedule 3, Division 2 did not have a specific line item. Ind AS 116 came in only last year, 2019. So this was an opportunity to introduce that line item. So a few more incidental changes which are considered critical have been brought in as part of Schedule 3. But the trigger for these amendments is only Keynote 2020 and to assist the auditors in expressing their opinion in Keynote, which will be possible if the preparers are reporting the same. So you have to see this entire Keynote 2020 amendments to Schedule 3 in this backdrop. Over the slides, as I walk you through the slides, wherever possible, I have reproduced that paragraph of Keynote 2020 as well to explain that this amendment in Schedule 3, requirement of preparer to report, is because of this particular paragraph. Wherever possible, I have done the same. Now, coming to amendments in Schedule 3 of Companies Act, a quick summary of 2-3 minutes. All of these amendments, approximately about 31 amendments are there. They broadly fall under 4 headers. These are not headers in Schedule 3. These are not headers in Schedule 3 or CARO. These are headers for our understanding. There are some amendments which have been done to increase the level of disclosures so that as a regulator, I can have more oversight on the governance, the quality of governance which is there on various aspects. For example, what is the extent of promoter shareholding? What is the shareholding change? In respect of charges, which when companies have borrowed money, whether those charges have been created on time, satisfied on time. If there are amalgamations happening or business combinations happening, whether the scheme of arrangement, the various terms of the scheme of arrangement have been complied with. So similar such requirements have been added as disclosures in amended Schedule 3. One of those important ones is this working capital reconciliation, and I would encourage and request that this one single item, please socialize with every single client of yours formally, communicate it formally, because else tomorrow there will be a client dissatisfaction, and also request your peers to do the same. I'm sure all of you, based on your experience, will recollect or rather be able to appreciate that when it comes to the working capital borrowings from banking system, we have a requirement of filing stock statements with the bank. It can be a physical stock, it can be receivables. What CARO 2020 requires is, if your working capital limits are above 5 crores, fund plus non-fund put together, then you are required to make an opinion as to whether the stock statement filed with the banks is tallying with the books of account. So you answer for yourself based on your experience. During the year on 30th June, 30th September, for unlisted companies, private limited companies, where we do not close the books formally. We do not close the books formally, whether what is filed with the banks and what is there in the books of account will tally 1-to-1 or not. If it doesn't tally, you are required to disclose a reconciliation as to why the differences is there. Not an easy one, extremely tough. I would strongly advise every client formally sensitize them that this is a requirement which is there now in CARO 2020. And also, as the preparer, also Schedule 3 requires the management also to give that. Then second is a set of changes for improving the financial discipline and also for getting an idea of the solvency of an organization. So preparers are required to publish about 11 ratios they are required to publish. Aging of trade receivables and trade payables have been brought in. There are some finer points which are there, which I'll highlight few minutes from now. Aging of capital work in progress has any reasonable sized company on an ongoing basis some capital work in progress. So you take up some expansion projects which can complete in 18 months, 24 months, 36 months. So aging of those projects, never heard of earlier. And mind you, some of these disclosures, you don't have it in any part of the globe, And if these capital work in progress projects, there is either a time overrun or a cost overrun, then there is a separate disclosure to be done of the fact of time overrun, cost overrun. So all of this require lots of documentation, lots of thinking by the board at the time when the projects are approved or submitted to bank for raising debt. So you can't have a particular time schedule for approaching the banks, a particular time schedule for your board approval process. So all of those have to be balanced. All of those have to be balanced. So that's another important disclosure. Preparers are required to give. Preparers are required to give. It will be quite challenging. Transactions not recorded in books, basically undisclosed income, if any, which comes in the process of income tax assessment, and around CSR spend. The third category of amendments in Schedule 3 are to give early signals in respect of money laundering. All of us are experiencing around in the ecosystem. There are reasonably good number of entities, maybe 5% of entities, 7% of entities. I don't have a statistic, but the reasonably good number of entities of different sizes, large, medium, small, where there are irregularities. And most often than not, these irregularities don't get detected because we don't have those red flags which are raised well in advance. So the amendments to Schedule 3 requires the company preparer to state dealings with companies whose names have been struck off. So if there are transactions of purchase, sale, lending, etc., where a company's name has been struck off, but you are showing a transaction is there, you need to disclose. Disclosures of Binami transactions, if there is some suit filed on the company for that. Cases where immobile properties are not held in company's name. Cases where entities have been declared as a willful defaulter. And there are many cases where companies borrow in their name and onward lend it to subsidiaries, joint ventures, associates, or special purpose vehicles. So some cases, like a company like L&T, there are hundreds of SPVs where money is raised at the parent level, push it down for each project to be executed. But there are other cases where monies get routed down. So those instances you are required to report where loans have been given, loans have been taken, end use of borrowed funds. So this is also a requirement in CARO, for which there is a requirement for the preparer to tell that, yes, we borrowed money for this purpose and we have used it only for that purpose. No, we used it for some other purpose. Then you disclose the fact. So the preparer also has a responsibility of disclosing those. Loans, advances given to the related parties like promoters, directors, and the relatives. Dealings in cryptocurrencies and crypto assets as well. And lastly, fourth category of changes. There are minor changes and edits which have been done since the Schedule 3 was, in any case, getting amended. But let me share with you, there's a much larger project we have to take up for amending Schedule 3 because there is so much of inconsistent information. And happy to share with you that at the request of the Institute, the government has moved some of the information to a category called additional regulatory information. So the idea is to make the financial statements carry information more related to explaining the financial statements. If the idea of government is to get information in addition to what is related to financial statements, then better to capture it in a different category. So a small beginning has been made where you have this header called Y, the header called Y, under which additional regulatory information has been captured. So hopefully that's a good beginning where eventually some of this information, which is largely meant for governance purpose, regulatory purpose, and not necessarily for understanding financial statements, will all eventually move to that category of additional regulatory information. For example, our financial statements, eventually as the 5th or 6th largest GDP in the world, should be comparable with the financial statements across the world. So if you have trade payables, MSME, etc., you don't have all this breakup in other parts of the world. This MSME, etc., is a breakup which you want it internally within our country for regulating discipline around MSME payments. But that has nothing to do with understanding the financial statements. So there are lots of such information which is there, which gradually we have to start moving it to that category called additional regulatory information. So I've made a small beginning. Hopefully over time, some shift should happen, and the financial statement should look clean, and the notes to account should carry explanations to what is there in the financial statements and as required by various accounting standards or Ind AS. And our financial statements should look comparable with the financial statements across the world. You should not have additional information which you are capturing only for your internal regulatory purpose, which hopefully over time will get captured under the heading called additional regulatory information. So some minor changes or edits have been done, like rounding off the numbers. Instead of turnover, we have now taken total income, and a small conceptual correction. Income, we had the total called total revenue, whereas income is the more appropriate terminology. So total income has come. So similar kind of changes have been done. All of these are minor edits. So let me begin with the amendments which are applicable for Division 1 entities, almost all of which are applicable for Division 2 and Division 3 entities as well. Some of these are less important, so I will move a little faster on this and spend time more on the Schedule 3 amendments which are driven by CARO. So first is this applicability of rounding off. So earlier the rounding off was done based on the reference to turnover. Now instead of turnover, you have to calculate with reference to your total income. So if your total income is less than 100 crores, you can round it off to hundreds, thousand, lakhs, millions, or decimals thereof. If it is 100 crores or more, then to the nearest lakhs, millions, or crores or decimals thereof. The difference between turnover and income, as far as turnover is concerned, it basically comes from your principal activity of selling goods, services, whereas income, total income, is the total income which you see in your P&L income statement, which has revenue, that is from sale of goods, services, plus other income as well, including gains and things like that. Together, total income. So henceforth, the rounding off criteria has to be applied with reference to total income instead of turnover. Second is a disclosure requirement for governance on promoter shareholding. We currently have a disclosure requirement of shareholders holding more than 5%, which more or less covers promoters as well. But the idea is to specifically identify the promoter shareholding and changes in the promoter shareholding during the period, either an increase or a decrease during the period. For listed companies, we already have this requirement as part of the LODR requirements. Now, this requirement has been brought in for all companies as well. So I don't think companies should have any hesitation in making this disclosure. The term promoter is defined in the Companies Act, and the same expression shall be used. Now comes this important amendment relating to aging. First is aging schedule of trade payables. And I would like to caution everyone here two important things. First and foremost is, all of you are aware that we have this rules relating to acceptance of deposits, and if there is any payable more than 1 year, it is treated as a deposit. So if there are trade payables where your aging is exceeding a year, there is a possibility that an inquiry will be commenced as to whether it is a public deposit and whether there is violation of those rules as well. That's one very important caution. Second is, this aging schedule of trade payables, you need to give it as trade payables for MSME and others, and you also need to give how much of these trade payables to MSME are disputed trade payables, and for others how much is disputed. So what constitute dispute, and at what level do you call as dispute? I would leave it that we should wait for the institute guidance note to come for us to form a view on that. A simple, my view, a simple mail or a letter saying that I don't accept this will not make it a disputed due. It has to be something more substantive. So at what extent it would be considered as substantive, we should wait for that. But this disclosure of disputed dues is important because tomorrow, if the other party wants to file a suit, and you are showing it as accepted dues, which means you cannot avoid the liability at all. So if you are showing it as disputed dues, there should be a strong rationale of why you are showing as disputed dues. Similarly, in insolvency proceedings and all, to establish the dues, this classification again will become important. There are two other points which we need to take care here. One is, this disclosure is for trade payables which are due for payment. So if there are total trade payables of, let's say, 50 crores, and the credit period has not yet expired for 30 crores, there is still credit period. Credit period is 90 days, and 30 crores you have not completed the credit period. Then this breakup needs to be given only for the balance 20 crores. Second point, there would be many cases where there would be payables without a specific credit period. So those cases, they'll be treated as due immediately. So if there is no specific credit period, they will be treated as due immediately, and they would come as part of the aging schedule. And any unbilled dues should be shown separately. As far as trade receivables are concerned, similar disclosure requirements, and I would strongly urge that when you are presenting to audit committee for the financial year 2021, while you may not disclose this in financial statements, it's important to bring it to their attention that next year when they prepare annual reports, previous year comparative figure, this information would be given. So 31st March 21, this breakup is still relevant. You are not going to report now, but you are going to report it next year. And it's important the audit committee and board members are sensitized on this. Once this kind of an aging is available, look at how the banks would start assessing working capital limits, etc., etc. So you are required to give your receivables broken up as undisputed, which are considered good, undisputed considered doubtful, disputed considered good, and disputed which are considered as doubtful. And for those receivables where the due date is not mentioned or the credit period is not mentioned, the credit period will start or the due date will start from the date of the transaction itself, and any unbilled revenue should be shown separately. Next is the disclosure requirements relating to property, plant, equipment, and intangible assets. This is the paragraph on fixed assets in CARO 2020. This is a new paragraph which has been added. Whether the company has revalued its assets, whether it is valued by a registered valuer, and if the change is more than 10%, then you are required to make a disclosure. Now, for India's entities, a choice of cost model versus revaluation model. So you need to ascertain. There could be some cases where people are doing transition for the first time So those cases, they may choose to do a revaluation. In days 101, they might elect that particular choice. Now, relating to this clause in CARO, we have the Schedule 3 amendment. There's an editorial change. Where earlier Schedule 3 used the expression called tangible assets. Now it is revised as property, plant and equipment. And the other change is with reference to revaluation. If the revaluation has an impact of more than 10% for each class of asset, you need to make a separate disclosure of the same. So earlier we used to have a disclosure requirement of additions, disposals and all. Now you have a separate disclosure requirement for the revaluation impact as well. It could be an increase or a decrease. Presentation alignments. One is in the context of current maturities of long-term borrowings. As far as current maturity of long-term borrowings are concerned, the Schedule 6 currently required disclosure under other current liabilities, whereas now the amendment has been done to show it separately as part of short-term borrowings. In the case of security deposits on the asset side, it was earlier shown as part of long-term loans and advances. Now it will be shown as part of other non-current assets, which is a more appropriate presentation. Additional regulatory information, again in the context of property, plant, equipment and intangible assets. This is the clause in CARO on fixed assets. I'll highlight the two new clauses and please recall what I mentioned earlier. The Schedule 3 amendment has been done largely to help the auditors to express an opinion. Auditors will be in a position to express an opinion only if preparers are making available that information as part of financial statements. And it is in this context that these amendments have been done. One, whether the company is maintaining proper records showing full particulars of intangible assets. And second, where title deeds of all immovable property, if it is not in the name of the company, the auditor has to report in a particular format. To facilitate that, Schedule 3 has been amended as part of additional regulatory information. This table needs to be given. Wherever title deeds are not in the company's name, you are required to give what is that particular item and in whose name it is there. And in practice, my own experience, there are many cases where land has been allotted, land has been purchased, but registration in our name is not there. So on the land, construction activity is also happened, but the title deed is still not in your name. So all of these will come here and suitable disclosures need to be made for the same. Similarly, there is disclosure requirement of whether the revaluation has been done by a registered valuer. You need to make a disclosure. This again comes out of CARO requirement. And where loans and advances are given to promoters, directors, key management personnel and related parties, you are required to make a disclosure of how much is the loans which are repayable on demand and what are the amount of loans which have been given without specifying the terms of period of repayment. And they have mentioned a particular format in which how this breakup needs to be given: promoters, directors, key management personnel, relatives, and percentage of loans to total advances. The precaution here is there are some disclosures you would in any case do as part of AS 18 or Ind AS 23. Related party, those disclosures will be there. But those disclosures are relatives as per the accounting standards. Here relatives is as per the Companies Act. So the two may not necessarily match, but it is very important as a preparer and as an auditor that you should carry a reconciliation, because sometime you might be asked to explain why there's a difference between the disclosure there and disclosure here. Then capital work in progress. I have briefly mentioned this at the start. For all the capital work in progress which you are having, you are required to make a disclosure of what is the estimated time of completion. You expect it to complete less than a year, 1 to 2 years, 2 to 3 years, more than 3 years. What is the estimated time of completion of each of these assets? And on capital work in progress, there is also a disclosure requirement. If there is a time overrun or a cost overrun, project wise, you are required to make a disclosure of it was supposed to be completed within this period, could not be completed, and hence this is the position. So what is the original timeline? What is the revised timeline? What is the original estimated cost? What is the revised estimated cost? And if any of the projects has been suspended, like the pandemic period, so details of the suspension has to be given. Similar disclosures are to be given for intangible assets under development as well. So capital work in progress for tangible assets. Similarly for intangible assets also, the aging schedule of expected time of completing it. And similarly, if there is an overrun, again details need to be given project wise as to how much is the overrun. Then disclosure relating to Binami transactions. We have this clause in CARO, which says whether any proceedings have been initiated or are pending against the company under the Binami Transactions Act of 1988. So for the auditors to express an opinion on this, the preparers have to give in the financial statements as part of additional regulatory information any property. If there are any suits which have been filed against the company for Binami transactions, they have to give details of such property, who are the beneficiaries, which item in the balance sheet this is included, if it is not in the books, for what reason it's not in the books, and the status of the proceedings under the Binami Act and the company's views on the same. And let me share with you all of this. There is substantial guidance which is required, because when something is sub judice, whether a company would like to disclose its legal strategy or its company's views on the same, so to what extent, all those are matters of question, which when the guidance note gets finalized, we should get clarity on the same. On working capital, we have this clause in CARO which has been inserted now, almost a suicidal clause for many entities, and I'm sharing this out of experience, and I have no hesitation in calling this as a suicidal clause for many entities. For most of the unlisted companies and private limited companies, it will be extremely challenging unless they develop a discipline of quarterly closure of financial statements. It will be very difficult to tie up between what is submitted to the bank and what is there in the financial statements or in the books of account. So if your working capital limits, and mind you, it is including non-fund based limits, if it exceeds 5 crores, which means almost every operating company will get covered here. And for those companies, you have this disclosure requirement. So in Schedule 3, the management, the preparer, has to give their assertion as part of additional regulatory information, whether quarterly statements have been filed and whether they are tallying with the books of account. If not, summary of reconciliation and reasons of material discrepancies. Pardon me for reiterating again, but I would strongly advocate formally communicate to all your clients in writing about this particular clause and ask them to be prepared while calculating all of these stock statement purpose 30th June, 30th September, and to get it properly reviewed. Larger companies, I'm less worried. Larger companies have a fair amount of control and people working. So most of the large companies will not struggle, but smaller companies certainly will have a challenge in terms of ensuring this reconciliation. Then comes the requirements relating to willful default and end use of funds. This again comes from the CARO clause. In CARO 2020, new clauses have been added, whether the company is a willful defaulter and whether they have been classified as such by any bank or financial institution or other lender. CARO 2020 also has a clause, term loans, whether they were applied for the purpose for which they were not obtained. If not, the amount of loans which have been diverted. This was a clause which was there in 2003 CARO. It was removed in 2016. It has been reintroduced now. Whether funds raised on short-term basis have been utilized for long-term purposes. So whether there is any diversion of money here. This clause also was in 2003 CARO. It was withdrawn in 2016 and is brought back. So as regards willful defaulter, in Schedule 3 amended, the company is required to make a disclosure as to what is the date on which they have been declared as a willful defaulter and the details of the default. And regarding the borrowings from banks and financial institutions, they are required to make a disclosure of whether the amounts have been used for the purpose for which the monies have been raised. If not, disclose the same. Next is requirements relating to solvency of an organization. This is the paragraph in CARO where auditors are required to make a judgment, express an opinion on capability of a company meeting its liabilities. We have seen rating agencies who have very sophisticated models and full-time professionals working on it. Failing on these judgments, they use very sophisticated models and lots of ratios and all. And we know cases where companies have been rated AA and above, also going into default within a short term without downgrades happening. Auditors are now required to make a comment in the CARO on the basis of financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities. Auditors are required to make a comment. Since auditors might calculate ratios in a particular way, management might calculate in a particular way, responsibility has been put on the management also to report a few ratios as part of financial statements. And on this clause, I would strongly advocate that the audit working paper should be very tight to form an opinion on this. It's not an easy judgment. I've been in the financial services industry for a long time. I have come across cases, I'm sure all of you as well, companies have been AAA rated by established rating agencies going bankrupt within a quarter. So in that environment, as an auditor, the ability to comment on the solvencies of the organization and all is something we have to be extremely careful. The working paper should be so tight that tomorrow you should be in a position to justify that I have done what I could. And there is no delivery gap from my end. There can be extraneous reasons. It's always possible. Like, for example, I always give this example. Audit opinion is like a master health checkup. I can have a master health checkup in the best of the hospitals, Apollo, and the health checkup can tell that I am healthy. Does not mean the next day morning I should not collapse. I can still collapse. The health checkup is based on certain conditions and a process followed. So we follow the audit standards prepared as per accounting standards. Based on that, you're given an opinion. But if you do an investigation, then something else could be detected. So like that. So here, tight working papers are extremely important for the auditors. So preparers are required to give these 11 ratios, current ratio, debt equity ratio, so on and so forth. And for each of these ratios, the numerator and denominator needs to be explained. You need to tell This is how I've taken the numerator. This is how I've taken the denominator. Of course, the guidance note when we prepare will address some of these. And internationally also, IASB is looking at a project, and it's sort of led by our own Dr. Zaveri, who was the former ASB chairman, who is now chairman of AOSSG. He is also piloting this project of developing ratios to be disclosed as part of financial statements. Currently, we have one ratio called EPS, earnings per share. So similarly, other ratios also, it is very nascent stages there. But in India, we have moved ahead with the requirement of giving this 11 ratios to be given. And if there is a variance of 25% between last year to now, then you need to explain the same. And please note, all these ratios you will give for current year, previous year. So for financial year 21-22, you will do it for that period and previous year period, and then 25%. So people need to, that is why I keep repeating that when you do financial statements of 2021 itself, you need to be prepared and caution all the audit committee and board members on the same. Intercompany loans, we have the clause in CARO, a clause relating to default and repayment of dues. Whether the company has taken any funds for meeting the obligations of its subsidiaries, joint ventures, associates, and whether the company has raised loans by pledging the securities which are held in subsidiaries, joint ventures, subsidiaries, associates, etc. And in this context, we have this requirement in Schedule 3. Please note, and at the cost of repetition, almost all of the Schedule 3 amendments now are because of CARO requirements. So here again, in this disclosure requirement in the financial statements, the company preparer are required to give a disclosure regarding loans given. If I am giving a loan which will be meant for giving it onward to somebody, I should make a disclosure of what are those type of loans which are given for onward lending. Similarly, on loans taken, if I have received a loan for giving it onward, I need to make a disclosure of the same and also make a declaration that I've complied with the provisions of FEMA where applicable, Companies Act where applicable, the various limits which are there, and that I have not violated the Prevention of Money Laundering Act, which means every preparer and the auditor, every preparer and auditor should have complete knowledge of FEMA. Most occasions I find auditors relying on others for views on FEMA and PMLA. Those days are gone. It is very important as chartered accountant to have a good understanding of the FEMA provisions and PMLA. While we may rely on subject matter experts to understand what they are inferring, also we need to have a basic knowledge. So in that context, it becomes all the more important because you have this specific assertion that you have this compliance with FEMA and PMLA as well. Other Companies Act requirements, relationship with struck off companies. So some companies have been struck off under section 248 of Companies Act 2013 or the erstwhile 560 of the Companies Act. If there are investment in securities, if there are receivables, payables, or any other outstanding balances, or if that defunct company is holding shares in you, if the defunct company is holding shares in you, then those details needs to be given. So these details are again not so easy to obtain, particularly shares held by defunct company. So if there are several shareholders widely held, then identifying list of shareholders and then seeing whether it is stuck off, that itself is a work. It's a substantial amount of work. I believe the guidance note when we develop should give some clarity on how to approach the same. Registration of charges or satisfaction of charges. If they are not done within the time limit, you are required to make a disclosure of the same, along with reasons as to why you could not complete it within the original time limit. There is a requirement in the Companies Act section 287 that you cannot have more than 2 layers of subsidiaries. So in case you have more than 2 layers of subsidiaries, you are required to make a disclosure of the same. Then another disclosure requirement is regarding schemes of arrangement, mergers and amalgamations. You are required to give a assertion, the preparer, the management has to give an assertion that we have given effect to the scheme of arrangement in the book. Accounting has been done as per the accounting standards, and if there is any deviation, explanation needs to be given for the same. This is a minor edit, is an important edit. In the P&L, earlier operating revenue and other income, it was called as total revenue. Total revenue is not a correct expression, so it's now changed as total income. Similarly, one more small change has been done. For Section 8 companies, their important receipt for them is grants or donations which are received. So those grants or donations received will be shown as part of operating income. So that's a new line item which has been added. This is the clause in CARO on unrecorded income. So in the context of tax assessments, so if there is some unrecorded income which is getting disclosed, in CARO, auditors are required to make a comment. Now, in the Schedule 3 amendment, the preparers are required to make a disclosure of the details of transactions not recorded in books, amount of income which you have offered, which you have surrendered for being taxed. If there is an immunity given in the scheme, then you need not disclose it. Otherwise, you need to disclose the same along with where it was earlier accounted. You disclosed it by showing it as a liability. For example, I showed it as a liability instead of showing it as income. So those kind of disclosures you need to make. And on CSR, we have a clause in CARO. This is a new clause where the auditors are required to give a comment on whether the Section 135 provisions of transferring unspent amount for ongoing projects, others are transferred within 6 months, 1 month respectively. So to facilitate auditors to make that opinion, we have a requirement in the Schedule 3 amendments where a company is required to share what is the minimum amount to be spent, how much we have spent, how much not spent, how much ongoing project, how much not ongoing project, whether you have complied with relevant accounting standard. All those disclosure requirements are there. And on cryptocurrency, I saw a comment in the chat box in Silvia's presentation. In India, of course, it's not legal, it is not allowed, but there can be instance of consolidated financial statements. So there's an Indian company having a subsidiary or joint ventures, subsidiary rather, in other jurisdictions where virtual currencies are allowed. So when you consolidate, so that entity will have a cryptocurrency which will come in your consolidated balance sheet and consolidated income statement. So those have to be reported. So if there is some if there is any profit or loss on cryptocurrency, an amount of currency, you have to make a disclosure here. So I expect legally this should be applicable only for those organizations where there is consolidated. If it comes in standalone, as someone mentioned in the chat box, as it stands today, it is prohibited. And incremental amendments in the context of division to entities, companies following Ind AS. So as I mentioned, Ind AS 116 was issued in 2019. It became effective then. So disclosure of lease liabilities, we did not have a separate line item. So that lease liabilities line item has now been added. And in this SOCI, statement of changes in equity, new columns have been added where if there are changes in share capital because of prior period errors, so that amount needs to be shown separately, and revised opening balance also struck in line with IAS 8. And for trade receivables aging schedule, in Ind AS, as Silvia was also showing, we have the concept of significant increase in credit risk and impaired and all. So those you need to make a disclosure separately, but those would apply largely for loans and advances, because for trade receivables, we follow what is called the simplified approach. And for NBFCs following the Ind AS requirements, there's one additional requirement, which is regarding a few ratios to be disclosed. These are ratios currently they disclose it to the central bank, Reserve Bank. Now they have to be made as part of financial statements. So Tier 1 capital adequacy, Tier 2 capital adequacy, and the liquidity coverage ratio. So with this, I've tried my best within the time available. Maybe I've overshot by about 5-6 minutes to introduce the amendments to Schedule 3. Happy to interact with you. And before I commence interacting with you on the chat box, I'd just like to conclude borrowing again a quote from this great gentleman of whom I'm a big fan. He talks about technical excellence in performance of work and observance of highest in professional ethics constitutes the foundation on which the future of the profession can be built. And Mark, these are words way back in 1949, and they're so true even today. So thank you all for your patient listening. My sincere thanks to my council colleague Aniket Talati. I'm not sure whether he's in the webinar today. Thanks to him for also referring my name to Chintan, and it's been pleasure working with him at the council, and more so the various digital initiatives he's taken. Plus at FRRB, he's been championing the cause of improving the quality of financial statements. My sincere thanks to a young chartered accountant, Ramesh Kumar Malela, who helped me in putting together this PowerPoint presentation. So thank you all once again, and wish you all safe and good health.
It's a fantastic presentation. Yeah, because the way you're taken up, I think you've done like everything Caro compared with Schedule 3. And that is what is the most important thing. Because comparing Schedule 3 along with Caro has actually opened up the reason of implementation in Schedule 3. So if we understand Schedule 3 without Caro in 2020, I think that doesn't make sense. So superb, I think the way you've taken up the reasoning behind every change, the way it's going to impact, and the cautious clause like trade payable you mentioned, like CVP mentioned. I think there are many things which you have to be aware. One of the most important things which you mentioned is the prior period item, prior period comparative. So for financial year 2020-21, we can't be sleeping idle. We have to start working from today itself, because for next year we need to have all figures ready for comparative financial year 2020-21. So that is the amazing, sir. We have few questions which are reflected on screen board, sir. Is it visible to you, sir?
Yeah, they're visible. I'll answer in the order. First question, Mr. Kuthalingam, is rounding off compulsory? The answer is no. If you are rounding off, then you have to follow the rules which are mentioned in terms of what should be the rounding off done. End user borrowed funds must be reported only for new loans taken during the year or for outstanding loans as on 31st March. It is for both. It is for both. Is Caro applicable if any one condition of capital 1 crore, 10 crore is fulfilled? It is either of the conditions. It is applicable. In countries like India, Bitcoin, I think I answered this. I saw this query in the previous occasion also. I've answered this. In India, it will largely come because of the consolidated financial statements requirement. In fact, at the institute, way back in 2017 itself, we have prepared a guidance note. I want to share with you. In 2017, we prepared sort of a concept paper. We did not publish it because if we publish an accounting guidance from institute, it might communicate that it is a permitted transaction. So even before the rest of the world actually started developing a guidance, we have done it in institute, and I'm extremely happy about the fact that we have that talent available in institute to prepare the concept note. And finally, when Japan issued a specific document on that, followed by IFRIC, their outcome of treatment and what we had visualized in 2017 are exactly the same. I'm sharing this just as a matter of pride that we as chartered accountants within the institute, thanks to co-opted members, special invitees, and the technical directorate staff, there is that level of knowledge available. Then question number 5, can we prepare financial statements? No, voluntarily not possible. It's applicable only from next year. There's no voluntary. Cryptocurrency restriction put in by Reserve Bank. However, Supreme Court did not deem investment like Bitcoin based on that. If a company, what is the auditor's responsibility? My view, as far as the cryptocurrencies are concerned, Reserve Bank has specifically mentioned. See, today it is not specifically mentioned as illegal anywhere. That is the bottom line. They said you should not. Rather, instead of calling it illegal, they said it's not legal. So it is currently in that state of limbo. That is why in Schedule 3 they are making this disclosure requirement. To my knowledge, people will not be held guilty for having done the transaction, except that banks are not allowed to carry those transactions. So there is no specific reporting requirement or a para for cryptocurrency in Caro, but managements have to report as part of the financial statements. Then can you make the screen bigger for the next question? Yeah, 7 amendments explained from the base. Okay.
Mishraji,
can you scroll down, Chintan?
Mishraji, please roll down. Mishraji.
Okay, while thank you for this positive comment. I just want to add one thing. While Silvia was presenting, there were a couple of questions around exceptional items and going concern. I would request all members. There's an accounting advisory published by Accounting Standards Board and Audit Assurance Standard Board last year on 29th of March. The lockdown happened on 23rd March. Within 6 days, COVID impact, ASB and AASB jointly published an advisory on accounting matters. If my memory serves me right, we gave 47 questions we have given, and one of those 47 questions is that exceptional items one. One of them is relating to the going concern. I would request you to visit the ASB page. It is there right as the first item of link. It is available. Advance received from debtors outstanding for more than 12 months seems not to be clear in near future how to be disclosed. Currently, we don't have a aging requirement on this. But I'm sure MCA will hear you. And if this aging requirement comes, so if you have received in advance the credit balance, and if it's more than 1 year, you trigger the deposits provision. And deposits provision non-compliance is a very serious matter. I'd strongly urge, if you have credit balance of customers more than 12 months, you need to take immediate steps. In fact, as part of March 21 financial statements, every credit balance, whether it is payables or it is receivables, please ensure that you are closing those receivables, payables with the concerned parties and comply with the requirements of the deposit rules. Please don't take a risk on that. Whether all the figures of previous year 2021 are required to be reported, yes, they have to be reported. Comparative needs to be given. In fact, let me use this opportunity. In fact, Aniket is also FRRB chairman. Hopefully someday he will do a program for you on non-compliances. I'll give one very simple example. Fixed asset schedule. Opening gross block 4 columns, depreciation 4 columns, net block 2 columns. So everyone gives it for the current year. Let's say financial year 2021, you give 1st April 20 additions, deletions, closing. But what Schedule 3 requires is, and accounting standards requires is, you have to replicate the table for the previous year also. So you should have 2 tables. The second table will be for the previous year fixed assets figure, you should give 1419 addition, deletion, closing. So I have come across 60 to 70% of companies don't give that comparative. That is a non-compliance. That's a non-compliance. People need to disclose that as well. Query number 11.
I think all the queries seems to be over.
Okay.
The way you explained,
Thanks,
I think
Chintan.
it has made very clear. And one of the most important thing which you mentioned lastly about the commonly found errors as a part of our Western India Accounting Conference tomorrow. The first session is of Aniket Talati is on this same topic, commonly found errors in accounting standards. And thank you so much, sir, for you being here. It's always my pleasure to have you here because I understand that the way you are being speaking, the way you are able to make the concept very clear, that is actually very important for all of us. I request C. Anjali Choksi, Secretary of Ahmedabad branch, to provide a hearty word of thanks. Anjali, are you there? There was some technical issues faced by Anjali, so she called me also. So I thought let me first try. In case she's not available, it's always my pleasure because it is my pleasure because sir, thank you once again from my bottom of heart for accepting my invitation and coming here. It's really pleasure. We wanted to have you more and more often, and it's really ICI is being too good. We are all fortunate to have you as CCM and doing your duties and helping all members to ensure that account standards go ahead, sir. So thank you once again, sir, for wonderful analysis. Thank you.
Thanks, Chintan. Thanks to all your colleagues for the opportunity. Thanks to all the members for the patient listening. Stay safe.
Thank you. With this, we close this webinar, and tomorrow we are going to again start on the same time at 3:30. And we have very wonderful sessions tomorrow to start with Aniket Talati on commonly found errors, and then the CFO panel discussions. 3 CFOs distinguished from various large companies are going to address. So see you all tomorrow at 3:30. Thank you so much.
Hello, Vikas sir.